Good morning, ladies and gentlemen, and we're actually off to an early start. Can you believe that? But you only find this in Pretoria. Last week when we were in PE, people enjoyed the view and the dolphins. They didn't really want to attend this session. But thank you all so much for being here this morning. Great to see so many of you in person again. This time last year, there was a lot of talk about the world going into, or two-thirds of the world going into elections. There was still talk about recessions. And there was still talk about being cautious on some of the asset classes like equity. But look what happened in 2024. It was absolutely a phenomenal year. Clients could have invested in anything: fixed income, bonds, property, global equity, and especially the global equity guys, they did phenomenally well. The questions I think that we're getting from a lot of clients at the moment are, are we still there? We had a couple of tailwinds, especially in SA. 2024, the elections turned out to be absolutely amazing. We didn't expect the GNU. So some of the questions now is that going to hold? And what's going to happen with all the Trump rhetoric around emerging markets and especially SA? Yes, it's taken a little bit of a backseat over the past week with happenings. If you look at Russia and Ukraine, and what's happening in Israel at the moment. But possibly an off-ramp on all of these geopolitical issues that we've dealt with in 2024. Where are we going for 2025? So this morning we're going to cover a lot of that in terms of what the world looks like. We've got all the experts here. We're going to cover fixed income and cover bonds, multi-asset funds, SA equity, and so on, to try and guide you on what to think about and what to look for when constructing client portfolios and how to position those portfolios. Just a couple of house rules before we get going. That all-important QR code, you know by now, if you want the CPD points, please scan in, scan out as you come in and leave. We're going to put the QR code on later this afternoon as well. If you haven't scanned in yet, please do so now. All the presentations and the recording of this will be made available on the Boutique Manager's website. So we will share all this information with you as we always do. From Robert, Walton, Amelia, Tanya, Olga, they're all here today as well. Big warm welcome and thank you so much for joining us here in person. Thank you for your time. We know things are busy out there and hopefully we can add a lot of value here for you today. And thank you for your continued contribution in making BCI the largest manco in SA. Our first session for the day is on local bonds. And as part of my opening, a lot of asset classes did extremely well. Some bond funds delivered in excess of 17% over the past 12 months ending Jan 2025. And that's unheard of. I mean, when last have you seen returns like that out of bond markets? But we also know in bonds there are certain risk factors. We've seen an uptick in US bond yields. We've seen a bit of a wobbly on SA bonds beginning of the year because of that. So some of the stuff we asking are, where are we going with US bond yields? And why are US bond yields going up? Are they expecting excessive growth, or are there more risks in the system that we may be not aware of? And how does that impact on the SA bond market, and how do we sit in the SA bond market? Magnificent asset class that can be held for clients, but to what extent? We've got the experts here this morning, and it's with great delight that I welcome Matthias Motsuehane from Argon Asset Management. He will be our first presenter. He will be followed by Raphael Nkomo from Tequanta Asset Management, and then JP Duplessis from Authorical, and Brandon Quinn from Saffron Wealth. Enjoying the session here today with us, and we hope we get the value you want. Thank you so much.
My name is Maisa Motsuehane. I head up multi-asset classes, Argon Asset Management. However, today, I'll be speaking in my capacity as a co-portfolio manager of our fixed income product range. And of course, I'm pleased to be opening the talks about local bonds today. We have a fantastic lineup of experts, and I'm pretty sure we're in for a treat. So, just to set the stage, I think we need to set up a clear picture and understand the global macro landscape and how it impacts local bonds. And we'll first start by examining of course, two most important macro variables, growth and inflation, and how that will impact policymakers. Most importantly, obviously, we'll talk about monetary policy, but then when we move to fiscal policy, I'd like to shift attention more to the funded strategy. There have been interesting quirks that I've been picking up over the past couple of months, where they've been shifting the calendar more towards T-bills, away from coupon bonds. So let's kick off. Here we see an economic surprise index of the US. Effectively, what it shows you is how economic data has been printing relative to economics expectations. And you can see from that deep negative territory that has come out from 2024, we're now in positive territory. Most important thing to remember here, surprise indices tell you nothing about the level of growth. It just shows you how economic data is sprinting away from expectations, and we can see a marked improvement from that deep drawdowns in 2024. So looking at what's driving these improvements, we look at comparison across sectors. The most important one that we believe we should be keeping a close eye on at Argon is the personal/household sector. That is the biggest driver of US economic growth. As you understand, about 2/3 of that economy is driven by consumption. So keep an eye on that. Bottom panel, you can see a snapshot of how it looked 6 months ago in August 2024. And the bottom panel, it shows what the picture is as recent as 21 Feb. And you can see right across the board, we've seen marked improvement, bar one sector, which is retail and wholesale. So much improved data releases relative to what economists have been expecting. Moving along to US growth, here I plot the US growth nowcast. Obviously, this is put together by the Atlanta Fed GDP Now series. In the white line, it shows you this is the GDP nowcast, how they've evolved over the past couple of years. And just below that, the blue line shows economic forecast for 2025. And you will see the nowcast has pretty much trended to levels consistent with what economists have been relatively consistent in predicting over the past 2 years or so. So growth in the US looks like it's still going to be hovering at around 2%. We'll look at inflation, and once you add that to translate it to nominal growth, you'll see that the very low risk for a recession. We will also look at DEC 25 SOFR implied recession probabilities. And as you can see in that yellow line that is trended to the bottom there, very, very little probabilities of a recession, at least implied from the DEC 25 SOFR futures. And then the blue line, it shows increasingly that soft landing scenario might be the one that is highly probable in this scenario. So real growth still looks like it's holding up. Recession probabilities continue to decline. However, let's look at inflation. We are starting to see worrying sign in US inflation. Of course, we peaked at about double digits mid-2022. We've moderated all the way to around 3%, and it looks like we're holding that stable. Remember, the Fed target is 2%. So inflation stabilizing above target, and the most worrying thing for me when I look at this, the 3-month annualized rate of change of CPI is tracking faster than its 6 months variant, which is also tracking faster than the year-on-year CPI index. This is a picture that is typically consistent with turning points in inflation. You can look at the series as history, you will see it's pretty clear what we're seeing here. So from this picture here, we can conclude that we have not seen the whites of inflation yet. There is risk that we might see upside inflation surprises heading into second half of the year. And of course, you look at FOMC participants and their rhetoric over the past couple of months. This uses a Bloomberg language processing model. It looks at the speeches from all the FOMC participants, and then it attaches a score to them. One spectrum on the right-hand side, it shows that they're hawkish, and then on the left-hand side, we see doves, right? You can see all but 3 FOMC participants are sitting as doves, and the most important committee member, Jay Powell, is sitting on the far right, properly hawkish. And it's understandable when you look at the latest summary of economic projections that were released in December. They had the Fed dots in there. In the green line, we see where the dots came out now in December relative to where they were in September. Remember, these summary of economic projections are released every quarter, right? So a marked upward shift in where policymakers see Fed fund rates evolve over the next couple of years. You check around 2025, we've seen the policy rate move up from 3.4 to just around 4%. So pretty hawkish shift in central bank rhetoric. And then moving along and overlaying the Bloomberg natural language processing model that suggests, that assesses whether the Fed is being hawkish or dovish, you can see in the white line above 0 indicates that FOMC participants have been generally hawkish. Below 0, the white line indicates that they're pretty much dovish, right? And towards end of 2025, you see that upward tick into hawkish territory. And of course, as you can imagine, there are some risks to inflation outlook, particularly when you think about Trump policies around tariffs, immigration, regulation, and those kind of things, right? So policymakers clearly turning hawkish over the past couple of months. However, you look at the long dot, evolution of the long dot. This is where they see the policy rate settling in the long run. I see that evolution in the white line. It's currently tracking at around 3%, and the policy rate is sitting 150 basis points above that number, right? So it creates a bit of a conundrum. There's people turning hawkish, but at the same time, their data is telling us that they are far away from being done with the cutting process. Let's then move along and see what the market has been pricing in. All right. Relative to 18 December last year and the most recent implied policy rate curve, you can see the yellow line back in 2018 has been an upward shift to now in February. And most importantly there, in that 1 month area, you can see the cut in March has all but been priced out, right? Policy rate flat, I think there's about 5 basis points worth of cuts priced in there. So the market also agrees with the Fed. However, it seems the market is a bit more hawkish, looking at the dots relative to market implied policy rate curves. So we also like looking at US monetary policy stance, just to get a better idea of the models that they use as a guide. What are they telling them? How would they likely react to incoming data that we see? And how are they distilling it into a future, an outlook for growth and inflation? Here, this we're looking at real Fed fund rates. We take Fed fund rates, we deflate it by core PCE, and then we look at a spread between that and the Larbach-Williams estimate of the natural rate of interest in the US. And you can see real Fed fund rates tracking well above Larbach-Williams estimates, which really is research that is put out by the central bankers. And the last time we saw this kind of positive spread between these two series, it was in the mid-90s. One of those was a soft landing was engineered at around 1995. The others, we all know how that ended. 99 led to the dot-com bust. Early 90s, we know the savings and loans crisis in the US. And then we look at another guide. We also always need to remember that policymakers tell us that these things are guide. They're not gospel. They use them as a guide. We look at the US Tyler rule here, right? And this instead shows that policy is quite loose, right? On that top section on the left there, the US Tyler rule estimate says that the policy rate should be sitting at 6.2%. Currently, Fed fund rate is 4.5%, meaning that we need to be hiking rates by about 1.5% to 2% to get this to neutral level. And you look at the variables that are causing to this, inflation is tracking above, core PCE is tracking above the inflation target, and then unemployment is well below what the estimate of NAIRU is. So it's understandable. This will demand, this will prescribe a tightening path going forward in monetary policy. So a quagmire in monetary policy, and from what we glean from Fed policy speak, is they're struggling to distill a view, an outlook for growth and inflation based on how macro policy has been volatile. Obviously, with new administration, you need to take a wait-and-see approach and react to what you know has transpired, not what you think that might not. Moving along to fiscal policy, here I'm not going to focus too much on deficits. I'll be focused more importantly on how they have been funding these deficits. I recently highlighted that in those blue bars at the bottom, US debt composition, Treasury has been pushing the issuance calendar further towards T-bills. You can see now we're hovering at about above 20% as a percentage of outstanding marketable debt. And through the TBAC Advisory Committee, they guided us that we should not be above 20%. So we know there's a problem that needs to be addressed there. And you look at T-bill share of auctions, you can see that these people have basically been flooding the market with T-bills. The white bars at the bottom there indicate that T-bills share of issuance is well at 85% now. Large numbers. And what has allowed this? We think the decline in the reverse repo balance account has allowed Treasury to pursue the short funding strategy. You can see on the right-hand side in the blue line, inverted as the reverse repo balances, peaked at around 2.5 trillion. We're now tracking around 63 billion. And in the white line, we show total outstanding US T-bills, and you can see that the lines basically track by side. I'm just going to skip through a few slides, given that time has run out. But the most important thing that I wanted to highlight is, indeed, this is a rational decision. T-bills have started paying an excess spread over reverse repo over the past couple of years. And this does indicate that market participants are acting rationally by pulling funds from the Fed and buying T-bills instead. However, the outlook is not going to change. This is an expert for the recommended funding schedule over the next 6 months. Historically, is in the gray bars at the top there, and what the committee recommended to issue in bonds, notes, and TIPS is basically unchanged for the next 6 months. So you can expect that T-bill issuance will continue unabated. And it's perplexing because this is an expensive funding strategy. In the dotted white line, I show the average interest rate that the US has been paying on their debt, and the blue line shows where T-bills, the average interest rate they pay on T-bills, that has single-handedly pushed up the average interest rate on the debt from sub 2% to now where it's hovering at around 3%. And you look at the other options, it is by far the only one that has pushed up that weighted average cost of interest rate paid. There's also another issue here that you need to be aware of, is the debt maturing profile. We see emerging refi risk with this short funding strategy. It's not only expensive, but then if you look at that white line, which shows the percentage of debt maturing in the next 12 months, we have north of 30% with US debt maturing. Going out 24 months, that number pushes up to 45%. And lastly, 36 months, they need to be rolling over 54% of outstanding debt. So it doesn't make sense from a cost perspective. It increases refinance risks. So what is really the trick behind this? And we think this is really a coordination between monetary policy and fiscal policy. What I show on the top panel is the T-bill share of total marketable securities. In the bottom panel in yellow bars, I show 12-month rate of change on central bank holdings of government bonds. You can see, like clockwork, every time that bottom panel goes into negative territory, i.e. central banks are reducing the central bank, the US Treasury holdings, the Treasury will step in and suck out that duration risk by limiting supply of duration risk at source and increasing T-bills. So policy coordination of sorts, with the end game being suppressing bond volatility and term premium alike. I've included some academic support for the claims that I made today, basically showing that this short issuance strategy compared to QE is exactly the same effect on markets. One just acts by limiting creation of duration risk at the source. The other just acts by taking out duration risk and hiding it on the central bank balance sheet. Essentially the same thing. So we construct Fed liquidity indicators at Argonne. Effectively, we just trying to get a clear handle of changes in bank reserves. And you can see our net Fed liquidity has tracked year on year S&P 500 performance quite closely. And heading to the far right of that chart, you can see that Fed liquidity is starting to become a headwind, and this would suggest the easiest part of the rally is behind us. I'm not the prophet of doom, but this suggests to us that the tough time ahead. And here I just deconstructed our Fed liquidity indicator for those of you who are interested to replicate yourself. We use year-on-year change of overall Fed balance sheet. We adjusted for the Treasury General account and, of course, the reverse repo, which has been the most important factor keeping Fed liquidity afloat. And lastly, to conclude, I just want to introduce a product here that really should be on your radar. We have a fantastic product here. It's designed to capture the best of bonds and protect, give you cash-like returns when bonds are not doing well. As you can see, the results speak for themselves. We've compounded near double-digit returns over the past decade, actually looking back to inception and beating our benchmark across all periods and consistently in top quartile performance. So this should be on your radar if you're somebody who's looking for income exposure. And with that, I'll conclude my presentation. Thank you very much.
Thank you, everyone. My name is Rafael Nkomo. I represent Tequanta today. I'm the Chief Investment Officer at Tequanta. The problem I'm trying to resolve today is, I suppose you're an advisor, you have an asset allocation decision that you've already made, and you've decided to allocate a portion of your assets to bonds. Now, the question that you're wrestling with is, how should you go about it? There are various ways of managing a bond portfolio. The first one is the traditional one, which is you make a lot of predictions about interest rate and inflation, and you look at the yield curve, and you decide as a manager where to position yourself around the yield curve. You can go long duration, you can go short duration, you can do a lot of things. There's another way, which is the passive way, where you say to yourself, active managers sometimes struggle to generate performance. I don't want to take any active risk, so I don't want to have my bond allocation underperform the OLB, and therefore I'm just going to allocate to a passive tracker. So that's the two ways. We want to show a third way today, which is you can position yourself in a fairly clever way where you generate performance above the OLB, irrespective of what the OLB does. And that's what I'm going to take you through. Now, I have the normal disclosure. And there's a disclosure I didn't put there, is that all models are wrong, some models are useful. Okay? So what I want to introduce to you today is the idea of portable alpha in a bond portfolio. And why is that important? Is if you look at this research by the S&P Dow Jones Index, you can follow active bond managers or equity managers. It's very difficult for managers to beat the benchmark. I'm an active manager. I could come here and tell you how good I am. The reality of the numbers is what you see. It's difficult. And therefore, the problem needs to be respected, and the problem needs to be dealt with quite in a different way. Now, one of the reasons why active managers underperform is the only reason that I can see, and probably the most relevant one, is because it's a zero-sum game. Okay, so let's say you have a group of active equity or bond managers. They're all buying the same stocks, and they're all trading against each other. So for me to generate alpha, I need to sell the bad asset to somebody else, and I need to buy the good asset from that person. That's where alpha comes from, right? In so doing, we net off the alpha. So the alpha at the end is zero. Somebody's gaining, somebody's losing, and vice versa. So after fees, then it's very likely that most managers, on average, are going to give you negative return relative to the benchmark. So that's the fact that you see in front of you. Now, what we do is, some people have said and therefore going passive might be a good way. The problem with passive is passive will give you the benchmark return minus the cost of trading. Okay, so I try to tally the various costs of implementing a passive strategy. As you can see at the bottom, you have 31 basis points of your money that is gone just because of execution costs. So if you follow a passive strategy, you will come out very close to the index minus the cost of execution. So we also don't believe that it's not a very clever strategy. Now, this is what we propose. There's a strategy that you probably heard, it's called portable alpha. And in a nutshell, portable alpha is actually very simple. Think of it this way. I'm gonna explain what is on the table, on the chart. Think of portable alpha. You want to buy a house. And you go to the market, Property 24, and then you find a house. Let's say the house is worth R1 million. Okay, now you're happy, you want to buy the house for R1 million. But it so happened that you're very fortunate you also have R1 million in your bank account. Now, so you have the house that you don't have, and then you have the R1 million in your bank account. The easiest decision for you is to take your R1 million, buy the house, and you're done. Okay, you have the house, and your account is empty. And then you live in the house, so your asset and liability balance because you gave the cash away and then you got the house. But most of us don't do that. Most of us go to the bank and say to the banker, I want to buy a house. You can see my balances in your account, in my account. I have R1 million, but I don't want to use my R1 million to buy the house. But it's never happened that the bank says to you, but why don't you use your R1 million and buy the house? The bank will say, yeah, we can fund the house. We can see you have R1 million, but we're going to fund, but would you mind just putting 10% deposit? So can you just take 100,000 of your R1 million and put it as a bank deposit, and then we'll fund the 900,000 rand for you. So what you've just done, you've just created a portfolio of an asset and liabilities, okay? So you still have 900,000 rand, you put a deposit of 100,000, and then you got a house, but you owe the bank 900,000 plus interest. Now think of this way, I owe the bank 900,000, I have 900,000 in my bank account. Now, let's say the interest on the bank balances is 10%. So every year, I need to come out with 90,000 rand to the bank. But I've got 900,000. So if I invest my 900,000 rand and generate 10%, so I'm netting off. I'm exactly the same position as somebody who bought the house with his own money. Now, if I can cleverly invest my 900,000 rand and generate 15% return, then I'm going to take 10% and pay to the bank. The net result is I'm going to have the house and I'm going to have 5% excess return. I think that is very clear. That's what portable alpha does. Simple as that. So when you give a manager, a portable alpha manager, your assets, we take two types of transactions on day one. We go to the bank at the bottom. Let's say you give us, I use probably 500 million rand. I go to the bank. I say to the bank, my client wants bonds. That's it. He's just interested in bonds. Doesn't want to know where interest rate is going. Doesn't want to know where inflation is going. Doesn't care about Trump and Musk. He just wants bonds. That's it. He wants the OB. The bank will say something like this to me. I will give you the return on the OB provided that you pay me JABA plus 75 basis points. That's a deal. Remember, it's a contract. I'm not paying the bank any money. I'm not taking your 500 million and giving it to the bank. It doesn't own your money. It's just a contract. We agree with the bank today that the bank will pay me whatever total return on the OB gate, and then I will pay the bank a funding cost, JABA plus 75. That is independent of what the bond market does. The bond market goes up 50%. The bank will still pay me 50%, and I'm still going to pay the bank JABA plus 75. If the bond market goes down 20%, and the bank will pay me a negative 20%, which means that I'm going to pay the bank 20% on top of the JABA plus 75. It's a contract. There's no exchange of cash flows. Now, because I have your 500 million in my bank account, now I need to deploy the house example. I need to deploy so that I earn more than JABA plus 75. If I can find such a portfolio that gives me more than JABA plus 75, then I'm going to get the result of which will be get whatever the bank gives me a total return plus the excess return above JABA plus 75. That's essentially what portable alpha does. And then in this example, if you price all of these today, you will see that in a cash collateral account, I'm earning JABA plus 275. I'm paying the bank JABA plus 75. I'm getting the total return from the bank plus the difference between the spreads. So I'm going to give you the all bond index plus 200 basis points. And that doesn't matter what the bond market will do in 1 year's time. Okay. Now, I know it rings in the head of most. It's like, is it true? Is it too good to be true? Does that work? Why aren't many managers not doing this thing? Okay. The reality is that why most managers won't do it, because if you position yourself as an active bond manager, you're not going to change that today. You're not going to go to the bank and then start to do this kind of structures. The second example is that to put this structure in place, there is a lot of other skill set that you need. You need to understand the contractual agreement between yourself and the bank. So you need some documentation that governs that, the ISDA and the GIMRAs and so on. The other thing is that you need to have cash collateral skill set and so on and so forth. So it's not really a free lunch, but it is doable. Now, I think the proof is usually in the pudding. Before I show you the performance of such a strategy, this is just the exposure that you will get if you go into a portable alpha kind of investment management scenarios. What I put on the right-hand side there is no active bets, no duration exposure, no sector exposure, no convexity, none of that, because you hold exactly the bond portfolio as it is in the OB. all you've done is that you've enhanced your return irrespective of the bond portfolio. Now, let's look at how this strategy perform. There is a little bit of slides about the collateral management and the skill set that I spoke about. I'm not going to waste your time with that collateral management. I just wanted to show you the performance of an active bond portfolio that we manage on the FundRock platform. And these are the performance as of January this year. And you can look at the performance for 2 years, over 3 years, and since inception. This is relative to the all bond index. So this portfolio does not take any views on interest rate, doesn't take any views on duration, doesn't take any views on inflation, doesn't care about the politics. It just tries to enhance the performance relative to the all bond index using that portable alpha strategy I've explained. And I think this is the long-term performance. As you can see, that the alpha, the bottom line, alpha, it accrues. And it accrues that way because it's a money market type alpha. So it's not a duration or a credit or just pure money market that we're overlaying onto the all bond index. This has been a bit of a contentious slide. I didn't put this because I wanted to show the managers. This is the data as per Alexander Forbes. So I didn't make up this data. I'm using that. It's in the Alexander Forbes surveys. They put this data every month out. So around about the 15th or 20th of the month, you will find that in all of the Alexander Forbes surveys. So they showed the active return versus the tracking error. The active return is on the vertical axis, and the tracking error is on the horizontal axis. And these are all the big managers in the country. And then the dots on the far left is Toquanta bond funds. As you can see, we generate one of the highest return in the market relative to the tracking error, a very low tracking error. And the reason is it's done so by design. So portable alpha works. It's a different way of investing. It doesn't take any views on where the market or inflation is going. It does complement active managers. I'm not standing here and saying that active managers is bad because I'm an active manager. It does complement very well the active managers, but it's a different way of investing your money. And that's what you can bear in mind. So just to conclude, I think there are a lot of merits in portable alpha. Personally, since we've invested in this, we found that a lot of our clients are extremely satisfied because we never go to a client and then tell the client about how bad, how unlucky our position was, or we just say, this is what's going to happen. You generally know what your alpha potential is going to be 1 year from now, and that is extremely important for your capital budgeting. You know that portable alpha is very unlikely to detract from your alpha performance. It doesn't mean that portable alpha, in absolute term, won't lose money. Remember, I'm giving you a bond portfolio, I'm just giving you an excess return above the bond portfolio. If the bond portfolio, the bond market goes down, you're going to go down with the bond market. I might go down slightly less than the bond market, but you're still going to lose as an absolute. In a relative term, you're probably going to have an alpha. If the bond market goes up, you're going to have performance. So it's not a derivative protection, absolute return type strategy. It's not. It's a relative strategy, but it does give you the advantage of generating alpha irrespective of what the market does. I'm going to stop there and for my presentation this morning. Thank you.
Good morning, everybody. My name is JP Duplessis, and I'm here to actually discuss bonds. Sorry. I'm going to talk about how managing bonds actively can add value to your guys' lives and to ultimately your end investors' lives. So, quick 2 slides on Methodical and myself. Methetical's been around since 2016. Close to 10 billion rands worth of assets, variety of different asset classes that we manage, equities, fixed income. I joined 4 and a bit years ago to launch the fixed income franchise, which we now have just over 3 billion rand in assets under management. So that's Methodical. I've been around for a very long time. I've been on the stage many, many times. 25 plus years for my sins, I'm a fixed income guy. That means that the glass is always half empty, not half full. That's just in our nature. But hopefully I won't depress you too much today. So I'm going to try and convince you that having an active fixed income exposure is a good thing and something you should have in your portfolio, and then obviously you should have ours. So why own bonds at all? That's kind of a critical question. I mean, some of you who owns bonds in their portfolio? Maybe a show of hands. Okay, so it's a pretty good number in the room. Going to cover that. Then I'm going to look at the characteristics of a pure bond fund. So something that's really tracking close to the all bond index, and the pros and cons of that. Is it better to buy and hold or to actively manage? I believe that it's better to actively manage, but I'll try and build an argument around that. And then briefly, what's currently priced into markets. I'm trying not to talk too much about what's going on in markets, as I did this presentation a month ago, and everything seems to change in the space of a month. So why own bonds at all? So the first thing to say is obviously people are looking for income. People are looking for yield. They're looking for steady returns, certainly steadier returns than maybe you have in some of the other parts of your portfolio. So even though bonds themselves may be more volatile than having money market or income style funds, they significantly lower risk than you might have if you have NVIDIA shares or something a little bit more volatile in your portfolio. So it's a diversifier. It has income characteristics. It does make sense to have bonds in the portfolio. But you don't necessarily want to have bonds in your portfolio like you've had in overseas markets for some time, where you just weren't getting reasonable returns for it. You were getting, in fact, negative real returns. In South Africa, you can have bonds in your portfolio and get CPR plus 4, CPR plus 5. So you're getting some of that income, you're getting some of that diversification by having other asset classes with less volatility, and you're getting, in South Africa, getting decent returns. Are you happy, Tian? Thank you. So a brief history of the all bond index and bonds in general. So I've now built bonds up, and I'm told you should have bonds in your portfolio, and I'm now going to say why you shouldn't just have a kind of pure bond exposure or bonds at all points in time. Because if you look at the history, the all bond index has done about just under 10%, 9.6% since 2000. That's a long period of time, with a 7.4% volatility. But if you look at the average multi-asset income fund, it's not significantly less than the all bond index, but it's done it at significantly lower volatility. And then obviously cash has performed quite significantly less, but with very little volatility. So I do think when you look at bonds as an asset class, it is an asset allocation decision. You need to be active in that allocation. There are times where bonds show good value, but again, there are times where bonds don't show value. This slide just shows you the performance of bonds over cash. So you don't have to look at like the detail, but what you can see is there's periods of time where bonds significantly outperform cash, as you can see there. And we had an example of that last year. Obviously, we all know what happened with the GNU and the rally that we saw in bonds. But there have also been times, that's Nenegate for anybody who doesn't remember that far back. There are times where bonds significantly underperform. And that's not just all done on emotion. Some of it's based on where pricing happens to be, what's priced into the market. And the market bonds are like any asset class. They can get carried away on the negative side. They can also get carried away on the positive side. So you've really got to manage that exposure. So why is a dynamic fund better? So I do have some issues with, fixed income indices are terrible. This is a universal statement I can make to you. You can show me any fixed income indice in the world, and I will tell you that it's terrible, because they are produced in a way that has. So if you think about an equity index, an equity index tends to have more of the better performing, better run shares in it, just by the way that it's produced. What fixed income indices tend to do is they tend to have the worst performing stuff in there. Because what happens when a company's not doing well, what happens when a government's not doing well, they issue more debt. So that it gets skewed to the size of the issuance. So fixed income indices aren't great in general. And this slide just shows you what we've seen with the funding pressure. This is just comparing a long-dated South African government bond with a short-dated government bond. And you can see, as we've seen funding pressure increase, we've seen steepness. Volatile, but we've seen that steepness from that funding pressure. If you just own the All Bond Index, okay, then you are forced to buy those longer-dated bonds because they're being issued. There's no kind of rhyme or reason for it other than the fact that the government is issuing out those longer dated. If you have an active manager, the active manager can say, well, I can get the same yield in a shorter dated bond without the risks attached to a much longer dated security. So an active manager can do that. Also, by having an active bond mandate or an active fixed income mandate, you can get a lot of the benefits of having that a lot of the income fund managers, and I run an income fund as well, have, in that we can go to look at a number of different types of asset classes. So there's a long list there, but there's things like you can have inflation-linked bonds in the portfolio. Currently, short-dated inflation-linked bonds are paying you inflation plus 4, inflation plus 5. Those are steady. You're hedged. Your inflation risk is hedged. Why not include those in an active fixed income portfolio? Whereas if you've got a pure bond fund, you're not able to take advantage of that. And there are points in time where obviously the risk rewards are different on these assets. And I believe that you need a fixed income guy or girl to look at that. Okay, markets update. I'm not going to go too deep. I mean, I know we all see a lot of stuff on what's happening with markets. What we're seeing is the combination in the US of fiscal pressure as well as higher for longer rates, which probably is going to put pressure on the economy. I know the US recession is this mirage that keeps on kind of disappearing down the road, but at some point we'll be right. Our interest rates, we have our own Bundesbank here in Pretoria that like to be super conservative in rate setting, much to a lot of people's concern. What are they worried about? Well, they're worried about the rand. Leseche, I think, wakes up at 2 o'clock every morning, sweating, thinking about the rand going through 19 again. And so they're very conservative, and so they very much take their cue from what's happening in the US. And the US doesn't look at the moment like they're in a big hurry to cut interest rates much further. So although there are very shallow interest rate cuts priced into our economy or into our markets, it's not a significant cut. We have seen a period of, I would love to tell you what last month's inflation number was, but they didn't print it last Wednesday. I think it's due out again tomorrow, right? I think it's tomorrow that they apparently it was too complicated to work out. Which does make you wonder. But we have seen a period of relatively low inflation. Inflation has been pretty low. But historically, over the last 20 years of inflation, a lot of our inflation has been driven by inefficiencies in pricing, inefficiencies in how things are worked, and that's worked through into our inflation numbers. And while the inflation picture still looks benign, it looked benign when I was doing this chart. Of course, then we had the 2% VAT budget, and now people are starting to get a little bit more concerned about inflation ticking up again. government workers' wages were locked in at 5.5%. So we do find ways of creating inflation, even in an economy that's not doing particularly well. So if I look at this slide, hard to see, but South Africa's here in the blue dot. Our credit is fairly priced given our ratings band. So we would need to see some improvement in our ratings. The budget that never happened did point to even higher debt to GDP levels. So slip again. Yes, there seems to be quite almost fixation with primary surplus now, but nevertheless, we still seem to have a drift higher in our debt to GDP. So, and more importantly, our growth, our GDP per capita is not growing, and that's really what a lot of these rating agencies look at. If the person in the street is getting wealthier, then the overall debt picture looks better. And as John Steenhuisen will tell you, you need a growth-focused budget, and we need to get growth to get ourselves out of the debt picture. It's not just about cutting spending. So yeah, just briefly on the fund. The fund used to be a pure All-B tracker, but I kind of got frustrated by the inefficiencies that were there just by tracking tracking the All Bond Index. And in fact, all of our clients are retail investors, so they're not really interested in kind of benchmarking per se. They're more interested in what is the return, what do you return, and what are the risks how does that pay off play against itself. So we've changed the fund and we've made it more flexible, so I can do some of the things that we do in the income fund, look at a lot of different types of asset classes, be a bit more active and react to market changes. We changed the fund in the middle of last year. The performance obviously been good because of the performance of bonds, but again, it's probably going to have less risk than the bond market over time, over the very long run. But trying to control some of that volatility, but get returns from other sources of fixed income. So yeah, this is just the conclusion. The fund is mostly focused on government debt or very high quality sort of bank credit, looking to beat all bond index returns, but with lower volatility, get that kind of CPI +5 returns for the longer run, take advantage of bond yields when they're attractive, but not necessarily stuck in all parts of the curve at points in time, can be a bit more dynamic across the fixed income curve. And that's my time. Thank you very much.
Good morning, everyone. Thank you to BCI for organising this event. My name's Brandon Quinn. I'm the CIO and general bottle washer at Saffron Wealth. So we deal with investment problems to air conditioners and water fountains at our offices. But such is the life of a boutique asset manager. We manage funds across the full spectrum of risk appetite. We've got the Opportunity Income Fund, which is our flagship fund. That has north of a 15-year track record. We've got our active bond fund in the medium risk quadrant that I'm going to talk about some more. We've got a great global income fund in dollars. It's a UCITS, registered in Ireland. We've also got a hedge fund in the high risk category. In fact, we have two hedge funds, one of which is available. It's a QIF. The other one is a private hedge fund. And then we've got our flexible fund. Our flexible fund is an equity proposition that uses a degree of portable alpha that my compatriot was talking about earlier, and seeks to beat the all-share index. That particular fund is about 2.5, 3 years old now. And there's been a lot of appetite for it. It's now north of about 550 million last time I checked. So there's the team. I bring the grey hair to to the team. The rest of the guys are really qualified, energetic youngsters. Some have a computer science skill, and that really plays into our strength, which is we're an active manager and we're a quants house. So what gets us up in the morning is looking at macro variables, modeling those macro variables. Sometimes the models are useful, sometimes they're not, but that's really what we're about. I'm going to do a little bit of the marketing up front. You can see there our Opportunity Income Fund, Class A, so that's at 100 basis points, delivers a very compelling return at materially lower volatility, and that's over 10 years. So I would emphasize the fact that our funds have performed well through long cycles, and you can see the amount of volatility that we've experienced, both positive and negative volatility in the bond market, but we really have to be looking through the cycle now. A lot of the good news has already been priced into South African bonds, and really we're at a point where you've got to say where to from here, how much risk are you willing to take, how much potential upside is there, and does it match your risk appetite. In terms of our active bond strategy, one of the core philosophies that we think about within our active bond strategy is volatility decimation. So our goal is to get you the all-B return at materially lower volatility. And you can see there from that particular chart how low the volatility is relative to our peer group, and that's the ASISA peer group. And our global fund, you'll also see there, our global fund has had a pretty good year last year. On a rolling 12-month basis, I think we maxed out at about 6% in US dollars. And now I think we'll probably hit 5.5 to call it 5.5% over the next year. So we think a 5.5% return in dollars after fees is a solid return. You'll also notice on our global fund that we've underperformed the benchmark. The benchmark there is effectively dollar cash, so for 3 months, plus 3%. So we like to set reasonably aggressive benchmarks because it keeps us working hard. But at the same time, we're also very happy to tap off the risk. So virtually since inception, we've tapped off a lot of risk in the global market, simply because we believed we could get the optimized risk-adjusted return in US Treasuries and some bank debt. So right now, that fund is about 60% in short-dated US Treasuries, which is incredibly boring, but it really is doing the job, and we expect to maintain that. Looking at our active bond fund and the general yield curve, you can see that both our active bond and our opportunity income fund offer compelling returns above the current or the prevailing yield curve. And like JP said, you do a presentation this week, by next week it's obsolete. In fact, sometimes the next day it's obsolete. So at the time of print, this was the slide. Okay, another important consideration that we don't spend enough time on is the liquidity of the funds. We model every single asset in our fund according to a realistic sales cycle. So in other words, not just hypothetically how long will it take for the cash to come back to us, but realistically how long will it take. And you can see there our opportunity income fund, basically we can liquidate the entire fund within, 25% of the fund within 1 day. And that's an incredible amount of liquidity that we generate for our investors. And very similar numbers on our active bond fund. The reason for that, of course, is because we're active managers. So we tend to sit on a lot more cash than potentially other managers. This was an interesting slide. One of our computer science guys at Saffron asked AI to generate a slide for us on tailwinds and headwinds for South Africa. And that's what computer software came up with. So I was quite impressed with that, so we had to include it. It had I think the bias they put in there was some painter called Gaudi. So it has a certain Gaudi ring to it. Yeah, very interesting. And for those of us that we were technically savvy in Microsoft Excel and Visual Basic, those skills are completely obsolete now. So I'm in a position where a lot of the guys that work with me are somewhat ahead with regard to their technical acumen, which is the first time in a very long time that's happened. Okay, down to some of the macro fundamentals. And this, again, is all quants-driven. And what you can see from this is the impact of monetary and fiscal policy on the South African bond curve. I'm going to cut to the chase. The red is the repo, and that's the impact of the SARB repo rate on our curve, and therefore on your all-bond index. And you can see how the impact of the repo rate is very prominent in the very short end of the yield curve, but dissipates over time into the 30-year. What that means, of course, is that your 30-year is much more anchored. It has lower volatility from a yield point of view, but that gets translated into very similar price risk because of the higher duration embedded in those long-dated bonds. The number that I always find very interesting is the US market and the US policy and how it impacts our yield curve. And that, of course, is the black line. And you can see how that grows over time. As one moves further out on the yield curve. So what it means is that we have to be monitoring US rates far more closely, even in the long end, than potentially South African macro drivers. Okay, so let's think about this. My eyesight's not what it used to be. This is the US number of rate cuts priced into the FRA curve. That's the forward rate agreement short end of the curve. And all I'm trying to demonstrate here is the fact that we've been flick-flacking. At one point, there were more than 10 rate cuts priced into the market. That's subsequently halved. It then moved down to about seven rate cuts. Then it halved again, went back to 7, and now we're sitting at 0. So there's a small chance of another rate cut coming out of the US, but on balance, we as active managers love this kind of thing because it means that an index could move from one point over a whole year and actually have done nothing. But there's a tremendous amount of value that can be added or taken away if you get it wrong, but generally added if one is a skilled investment manager, to the total return profile by positioning the bond fund correctly at those what we call points of inflection. Okay, I always like to include this slide because it really is a canary in the mine with regard to the South African economy, and that is commodity prices. South Africa is a commodity-producing country, and the price of commodities determines our fortune and the extent to which our fiscus is healthy or not. And you can see there, this is a rolling one-year return. Over 1 year, commodities have virtually done nothing. So if we're thinking about headwinds and tailwinds, currently it's somewhat of a headwind because it isn't converting our kind of competitive advantage into any kind of meaningful improvements in our fiscus. And the dependencies of this improving largely lie at the door of the Chinese central bank and the extent to which we can get Chinese growth to come through. Obviously, there's operational concerns like Transnet. I'll talk a little bit about Transnet going forward. In terms of operationalizing our access to improved commodity prices, but really we are a commodity-producing country, and we ignore commodity prices at our peril. One of the things, again, I'm going to beat on the active management drum as well. The problem with the index is that it's an index. You have no choice about what's in that index. We hold no state-owned enterprises at this point in time. We have a long time ago, but we hold no Eskom, we hold no Sanral, we hold no Transnet in particular. And that really, whilst it decreases our potential return because they are trading at attractive levels, it does ring true to our risk appetite. So I think that's an important differentiator with regard to being an index tracker or an active manager. Okay, looking at CDS spreads. What are CDS spreads? They're credit default swaps. They measure the credit worthiness of a country. And you can see that after COVID, we've had massive compaction, even in the likes of Turkey. You look at a chart like this, and we all wish we'd bought Turkey at the time. But at the time, it didn't look investable. Looking at South Africa, we've dropped below that 200 basis point level. And really, there's not a lot of scope for further contraction in our credit or sovereign spread. An additional headwind that this presents is, of course, the fact that we're already on a positive watch with S&P Global. And given the recent events, it does call into question whether they're going to be able to give us that ratings upgrade, which makes their previous positive credit watch actually a headwind, because to some extent it's already priced in. So to the extent it doesn't eventuate, will mean a reversion in that CDS spread. Peer groups. We spend a lot of time looking at peer groups. Why? Because really, we're in a global market, and global investors have the option of investing in South Africa, Brazil, Mexico, Argentina, God forbid, and other economies. The blue line there is Brazil, and you can see that Brazil is offering a very compelling return. We on the other, well, not on the other hand, we are also offering a decent return, sitting there, relative to US rates there. Now, Brazil has some very specific kind of socio-political problems, which has resulted in that widening of the spread. South Africa widened somewhat as well. But at the end of the day, the spread that we offer relative to US rates is what we call the carry trade. And that means that a US investor could take his dollars, convert them into ZAR, and buy our 2035 bond at 10.50 or thereabouts, and effectively pick up the differential between his funding cost and the return that he makes on the local currency debt. What it implies, though, is he's taking currency risk. So right now, the differential between our 10-year bond and the US 10-year is about 6%, which means that he can stomach 6% worth of currency volatility before he makes a capital loss. That's not a bad number. And to a large extent, we think that's been the reason why our bonds have been so resilient. We see the volatility in the rand, we see the disruption in the GNU, we see the budget problems we're having right now, and yet our rand is pretty stable and our bonds are relatively stable. That's because we're offering that surplus spread that is still attractive and that cushions the ability of foreign investors to buy our bonds. Looking at South Africa and the number of rate cuts, I think without walking around the corner to see where the last point on the curve is, there's about the potential for maybe another 25 basis points cut. South Africa tends to follow the Federal Reserve. We don't really step out of line with regard to that, even though, and it does bring up some interesting questions, even though from a trade point of view, we're probably more Eurocentric and China-centric. The problem, though, is that most of our offshore debt is denominated in dollars. So we do need to be cognizant of how we manage that dollar relationship in particular. I know we're running very short of time here. Just SA versus the US again, you can see that enormous differential, and that's really what is cushioning our bonds. The same there with regard to our repo rates. Interestingly, you'll see there when the repo rates differential tends to get tighter, our rand tends to sell off. That's because of the unwind in the carry market. Right now, there's a fairly healthy spread, so we can probably expect support from the carry market with regard to foreign participation in our market. Just a quick summary of the headwinds and the tailwinds. I think I've spoken mostly about all of these. Global interest rates, their low rates are still supportive of our attractive carry yields. We need We need some improvements in the commodity cycle. That's quite a touch and go decision right now, depending on what the relationship is with the US and whether or not the Chinese economy is going to be able to pull itself out of the property market hole that it finds itself. In terms of headwinds, the previous speakers have obviously spoken about our outstanding debt sitting at 72% of GDP. It's a high number. It's not as high as the US. It's not as high as the European Union, but it's still high for us, given our low growth trajectory. What's been of kind of particular concern for us is the stability of the GNU. We participated in the GNU rally quite extensively. I think you would have seen the returns we made, but we actively trimmed, massively trimmed our bond position into that strength, simply because you look at a balance of probabilities and the return of the Albi over the last year. On balance, it doesn't do that. Doesn't yield that kind of return that often. So you really have to be thinking about, the way forward, and is this return replicable? Okay, now somewhat of a summary slide, and this is the all bond index that's stress tested. So we take each individual bond, we stress test it from a total return point of view over time. We push the bonds forward in time and look at what the impact will be of various interest rate scenarios. This is literally a parallel shift. So we're just saying overall, if rates were to move in a parallel fashion. There are two frames here. The first is based on a stochastic analysis of long-term trends, and it gives us a potential range of where these bonds can move. And you'll see, if I recall correctly, it's about 2.5%. And so in other words, it's 1% down and 2.5% up. So that makes sense right now, if you think about it. It's skewed to the upside, just from a purely mathematical, stochastic point of view. Why is that? Because we have rallied so hard. So it doesn't mean to say that it's a predictor of the future. It just means that on balance, a lot of the fat or the surplus return has already been made. Then if we look at it from a more short-term perspective, you can see the second frame. And the second frame, interestingly enough, gives it approximately a 1% movement on each side. So these aren't numbers that we made up. This is what the maths tells us. So it says that there's about a 1% either way potential range. The black bar there is 10.6, so that's where we are right now in terms of the yield of the all bond index. That 810 I snuck in there is what you will earn on a 1-year deposit. Why do we use a 1-year deposit? Because this is a 1-year stress test. So it's what will bonds return for you over 1 year if interest rates move within those ranges. We believe, and this is our active management, purely an active management view, we believe that there's probably between 25 and 50 basis points worth of lower rates that we could potentially make out of the market. That would give your all bond yield, total return, somewhere between 13 and 15%. Okay. So slightly bullish on the bonds, 13 to 15. It's not a bad number. If bonds sell off by 50 basis points, you'll earn 7.61. So that's also not a bad return relative to a fixed deposit sitting at 810. So in a fund such as ours, with daily liquidity, you could make with a 50 basis point stress test, you will make not too far off what you'll make on a 1-year deposit, and you'll have access to your money because of the liquidity profile of our fund. Thanks.
Many thanks, Brandon, JP, Maitsi, and Raphael. I told the bond guys I'm not going to do a Q&A afterwards because I know they're always very passionate about what they do and they normally go over time. Right, we are going to move on to SA Equity. We are going to have a bit of a question session with the SA Equity guys afterwards. The bond guys are all still here with tea time, so if you do want to engage with them, please do so. Very fortunate at both BCI and Fundrock to have partnered with some of the top talent in the country. On SA Equity 2024, February last year, a lot of SA Equity guys stood up here and made an extremely strong case for SA Equity. We didn't feel it then, but again, look at what happened. SA Equity did phenomenal well. Question always is then, we had a lot of tailwinds during 2024. Does a lot of those tailwinds still persist? There's some slow improvement in our economy, and it seems like business confidence are turning in the right direction, but there are definitely things that we need, like growth, and it's been mentioned by some of the previous presenters as well. We don't see a lot of growth in SA, and now with things, we're back to load shedding again. And during our presentation, there is going to be a switch over from the current load shedding to back onto the grid, so there will be, I think, about a 15-second downtime, so we are going to experience load shedding here today as well. But again, these kind of things are constraining growth in SA, and there's a lot of questions like, is a GNU going to hold? Is it not holding? Look at what happened with the budget or no budget. Where are we going with SA Equity? First up, very fortunate to have Roger Williams from Central Asset Management. Roger, thank you very much for being here today. Roger will be followed by Tumi Luate from 361 Asset Management, and then Charles Gous from Batelier. Roger, thank you so much.
Hi guys, my name's Roger Williams. I'm going to talk about our SA Equity Fund. We launched it about 15 months ago. We had a very successful 2024. We were the top performing fund in the country. I'm going to talk more about our process rather than a lot about South Africa and what differentiates us. So I'm going to give you some insight into our process. Let me ask with the question, with so much noise, how can we predict anything? And when we look at shares, we really think about it very deeply. And what's most important is really the characteristics of the share and the relationship between the customer and the company. Let's take, for example, Microsoft. We all use Microsoft on our desktops. And Microsoft started, by a fluke of fate, actually developed into the standard desktop operating system. And once they had a standard, the PCs actually exploded because now everyone was using a similar process. From there, they had Word and Excel, and they entrenched their position more and more, establishing Outlook in the late 90s, and recently Teams. And Microsoft really owns a part of our head. Very high switching costs, and really you could argue under-monetized at this stage. What that results is a very strong profit trajectory and a very powerful business model. So when we start looking at a business, we try understand the business model and what the business does. And this has given us a table which we call the profit protecting power of a business. So if you own the standard, it's almost a 10 out of 10 power. The power of the business and the profitability of the business is a 10 out of 10. So if you just think of Microsoft and very strong businesses, if they're really scrimping for profits, what do? They just raise prices. And that allows constantly growing profitability. But on the flip side, let's say you've got a commodity with a cost disadvantage. Something like Sibania's a high-cost platinum and gold miner. When the platinum group metal prices rocketed in 2021, they did exceptionally well. But now that profits have come down, not such a good story. So you use this table really to identify the business model and how robust the profits are and the predictability of the profits. Just like instead of Microsoft, we've used Tencent because Tencent essentially, through Naspers and process, is the biggest listed company in South Africa. And you can see also a very, very robust business model, really owned the standard in China, very similar to WhatsApp, and they've added games onto that, payment systems, and made it a very robust ecosystem. So you can see Tencent over the last 5 years has more than doubled profits, whereas Sibanye in 2021 did exceptionally well when rhodium was through the roof, palladium was through the roof. Subsequently, the profits have come off substantially, and so too has cash flow. So we use this insight to understand the business. Doesn't mean we won't buy Sibanye, but we understand it's not going to be a long-term value creator and not something you get married to. But if we're very positive on PGMs, as we were in 2018, we bought Sibanye, but subsequently sold it because it's a hot potato you don't want to own permanently. Now, we really take this into our process. So the business model and the characteristics, really the microeconomics of the business, and the positioning feed into a valuation model. So that's really the starting point. Then management's really critical. We want management who are shareholder-focused and also dynamic, so they want to grow the business. And the culture of the business, equally important, that management can execute. So all these factors come together into a valuation, and then we compare the valuation to the market price. And when there's a divergence between the market price, let's say the market price is low, let's say 50% discount to the valuation, that can lead to a great opportunity. But normally it requires a catalyst to converge. And really, by exploiting these mispricings, Centaur is able to outperform and really find some excellent stock picks. Just giving an example that the flexible fund utilized about 3 years ago. So OUTsurance, we really like the business model. A disruptor, it's been going for over 25 years now. But really where it makes an extra margin is going direct to the consumer. So they've taken out the middleman and used that for marketing, but they've also managed to get far superior profits than their competitors. So just looking on the next slide, you can see their underwriting margins being about 25%, whereas Santam, which is a very good conventional insurer, has struggled to really consistently make more than 5%. So that's really the power of the business model in profitability. But also as a disruptor, they're able to undercut because of their business model, also price far superior because they've got the data, who their customer is, and they build up a superior database. And management are also focused on growth. So they took their model overseas almost 20 years ago, maybe 15 years ago, into Australia, and the Australian operation's much larger than South Africa. And within OUTsurance was part of RMI, which had also both Discovery and Momentum as major holdings. Management decided to unbundle this whole structure. We saw that as a catalyst. RMI was one of our largest holdings at the time, and it's probably doubled over the last 2 years. So we're seeing an undervalued situation, a catalyst, and that really leads to outperformance. And this is what we're looking for in Centaur, and this is what we buy into. Some of these stock picks, we're also very disciplined in our process. If something doesn't work, we need to cut it. We've also got time horizons, so we need to be very wary of an investment thesis that doesn't work and becomes a value trap. But also, we are active managers. So what we're finding is a lot of equity funds these days are not taking so-called calculated risks. They're more tracking the benchmark and saying, listen, we don't really know. We can't really find opportunities. Centaur is an active fund manager. We do our research very in depth. We try to see management as much as possible. And our active share is exceptionally high. So you can see close to 75%, whereas the average SA equity fund's closer to 45%. So that really sums it up, short and sweet. But just how has that manifested in performance? So since inception, we're looking to outperform on a pre-fee basis between 4% and 5%. We're looking to deliver that in alpha. And it's not only stock picking, we also look to have some trading alpha within the fund. So buy well, buy on dips, sell into strength. And we think we are quite skilled at that. So that's another incremental source of alpha. But the fund, since inception, outperformed its benchmark by 4% per annum and delivered 21% returns. I think South Africa's maybe, compared to 6 months ago, the mood's got a little bit more muted, but I think there's still positive things happening. There's some great companies around, some very high-quality companies, something like FirstRand, which has been growing at probably 7-8% for the last 2 decades, is yielding 7%. I think that's a very attractive return. So there are good opportunities still in South Africa, and I think our returns of 15% in our fund are achievable over the medium term, which I think is very good compared to other asset classes. I think over the last decade, it's almost been a one-way bet to be offshore. The MSCI has been exceptional. The S&P has been exceptional. And I think you have to decide how you're going to allocate your money and how will you navigate the next decade. Thank you very much.
Good morning, ladies and gentlemen. I'm Tumi Lawate, a co-portfolio manager of the multi-asset funds at 361 Asset Management. And before I highlight our macro views and our local views on the equity side, I'd like to talk to 361 and 3 key differentiators. The first being almost a third of our assets under management. We manage just over 60 billion. A third of it represents hedge funds. So we always talk to this hedge fund thinking, this hedge fund capability, really the ability to identify in stocks what can go wrong, manage that downside, and I think this is one of our key differentiators. The second, in terms of performance, if you look across all our funds, whether it's local equity funds, our flexible equity funds, and our hedge funds, all of them have outperformed their respective benchmarks 100% of the time, whether you look at it from a 1-year period, 3-year, 5-year, and since inception. So our performance really is our own track record that we own, and that's the track record for the last almost 20 years. Last but certainly not least, we're style agnostic. So we don't box ourselves into a specific style, whether it's value, growth, quality. We like to outperform during different market cycles and look at stocks from a fresh perspective, whether we think that stock has a long runway. And so we actually style agnostic. Then if you look at our SA equity, how have we performed versus peers? We've pulled here the Alexander Forbes Manager Survey, and it looks at your 3-year return relative to risk that's been taken. If you were to look at the 361 SA equity composite there versus our peers, right there on the far left, if you can't miss us, we're in the red. Quite a good performance just in terms of returns from an annualized return perspective. But if you also look at the risk that we've taken, very low risk in comparison to quite a majority of the funds. So we've ranked number 1 out of 48 in the benchmark cognizant SA equity managers from a Forbes perspective. And then I spoke to that hedge fund thinking and that hedge fund capability. How have we fared in terms of managing and protecting capital in your downside? We managed to produce a return of around 12.2% versus Quap Swix in the year 2020 when we had that COVID and those global lockdowns. So it really talks to protecting capital during those down months and being also able to capture that upside once those stocks have really sort of brought in the minimized value of the stocks. And then in terms of months, this is quite a stat that we've just computed actually, and we were looking at how many months have we outperformed. And 75% of the time, we've managed to outperform the relative benchmark when comparing a monthly return on a monthly return basis. If you look at our 5 years return, we've pulled there the information ratio versus peers. So our information ratio just stands below at around 1.73. And an information ratio of 2 is exceptionally good. So this talks to your ability to exceed your outperformance, double your outperformance relative to your benchmark and relative to your risk taken. And we are sitting around 1.73 for the last 5 years versus our benchmark. What really talks to this consistent outperformance? And I'll highlight 3 things. I've mentioned already the hedge fund thinking. Our ability to also be nimble and flexible as information changes, so being able to adapt to the market changes and looking at your sector rotations and seeing which sectors are set to benefit from information as and when it changes. I mean, if you look at last year, 2024, we were quite positive going into the SA election. We didn't really call the GNU, but we thought quite a business-friendly party would come into power, so we were quite significantly overweight SA Inc. We took the opportunity towards December, the latter part, to take some profits in the SA Inc. stocks, particularly the retail stocks, as people were pricing in quite significant jumps in the two-pot and people being able to take out from the two-pot system. And although the retailers did see some increased benefits from the two-pot, it was not versus the expectations that a lot of the market had expected. So this talks to our ability to be flexible and nimble and really trade accordingly versus our sectors. And last but not least, here I'll talk to one of our intra-sector rotations within the resource sector. We've measured here the resource sector from 2019 up till 2024. How have we been able to fare versus Capswix? And in every single year, we've managed to eke out some good returns from a resource sector perspective. Whether it was being overweight platinum at a time and then significantly underweight at the right time, this really talks to looking at the information at a point in time and really seeing how the sector is going to fare going forward. I mean, we didn't use AI to create our volatile year slide. I saw the guy from Saffron had used AI. We're basically highlighting here that we are shaping up for a very volatile year. I mean, in South Africa, we've seen the GNU, and the GNU is on, the GNU is off. The DA maybe is initially upset about the land expropriation bill, and then they're saying, okay, no, now we're going to look at NHI as our next big driver. So this year is shaping up to be a very volatile year, whether you're looking at even the US and global economics, or you're looking at South Africa. And for us, we actually do very well in a volatile year as we're able to grab those opportunities, whether it's from an over-owning, being overweight or underweight specific sectors. And then we can't get away without talking about Trump and tariffs. So as soon as the US elections concluded last year, we saw the Trump policy administration advancing on key policy initiatives. And we are seeing shifting trade policies really be the theme that everyone was talking about, particularly at the start of this year. So we were expecting shifting trade policies to really reach far implications for markets and industries worldwide. At the start of the year, you saw the Trump administration really arguing and having rhetorical battles on competing strategies. And there were two strategies. The one talks to strategies used to target key industries and sectors and critical supply chains in the US, whereas your other strategy just talks to using tariffs as a broader tool to exert leverage and really advance on key foreign policy objectives. We expected both to come to the being, and we've seen with Trump that both policies have actually come to light. He's using it as a broader tool to exert leverage, and he's also trying to target key industries. You saw the likes of steel and aluminium come through on the tariff side. What we're actually expecting is the next phase of global trade will really talk to shifting political alliances amongst countries. We're expecting localized production networks. People will continue to shift their production and their supply chain. People try to do this post-COVID-19, and although it was expensive and timely, you did see people try and use less reliance on countries like China in terms of their supply chain, and we expect this going forward to continue to be a theme. Then everyone says tariffs are inflationary. So how is Trump going to balance out with a deflationary counterforce? And so in his first Trump presidency, you saw him really target and highlight his frustrations on the oil price above the $70 per barrel mark. And what is he going to do in the second policy? So for us, we think that oil has likely peaked for a number of different factors. The first being we're expecting conflict resolution with the likes of Russia and Ukraine in the next few months. And that will reduce the geopolitical tensions impacting on the oil price. But second, I mentioned tariffs. We're likely to see that oil being an easy target for Trump to try and actually use it as a deflationary counterforce to those tariffs. In his first Trump presidency, you saw when it went over the $70 per barrel mark, he really targeted OPEC and their production. And we expect him to continue to try and influence OPEC and try and rein in on the oil price going forward. So we do think that oil has likely peaked, and we're also seeing some downside risks to the oil price. Yes, we're negative oil, but how are we on precious metals? Just specifically on gold, we didn't see any significant ETF buying in terms of the gold shares, but we did note that quite a lot of countries have been significantly picking up oil as part of their reserve management. So even China, after a brief hiatus, after the Trump election, it started picking up buying gold once again. So there's been quite a strategic shift in terms of global reserve management. People are moving away from just pure US dollar assets and also trying to hedge out on currency risk. And they're actually looking to purchase some precious metals, particularly gold. And we've actually seen the US actually talk to its lowest FX reserve since the 1990s, in people actually trying to strategically shift away from the US dollar into other precious assets. So we expect gold to have this underpin. Besides everyone talking about the geopolitical tensions and the uncertainty, yes, gold really benefits from that, but it's also going to benefit from this reserve management change and the strategic shift in reserve management, not only from China, but also the likes of some of the EM countries also purchasing gold as part of their reserves. Then we had the bond guys also talk to some of the rate cuts that are priced in. So we've specifically looked over the next 12 months what rate cuts are priced into the market. And if you look at it from a 12-month perspective, UK is the lowest. UK is, in the middle. The Europe is the lowest at around 1%, the UK at around 60 bips, and the US just at around 40 bips. This changed slightly to 30 bips just after the US inflation overshooting a little bit in the last month. So this is quite positive for risk assets. If the central bank actually sees that there's actually growth scares in the market, they could continue to look at cutting. So we think this is quite positive for the market going forward. And then for China's actually, we all know what's happened with the property sector and the ripple effect it's had on the country and the economy at large. But we think that China actually has three options to actually counter what's happening in terms of the risk that we are seeing. First, they've been making quite a lot of adjustments to your reserve requirement ratio. So this is the reserve requirement ratios, and it impacts the bank's lending. And this has improved liquidity, but it really hasn't solved a lot of the economic structural challenges that we've seen. The credit demand is the lowest it's been in 15 years, but in terms of the plans required, the first plan that we see is if they can increase exports. So people were looking the last 2 years on electric vehicles, how they've managed to actually increase their exports on that front. Yes, we think this is capped, though, given the geopolitical risks and people clamping down on how much they can actually export from an electric vehicle perspective. The second is promoting new technologies and sectors. So the likes of artificial intelligence, new energy, and green energy are some of the sectors that they can look to promote. They've done quite well in terms of e-commerce and digital payments, so we think they can really look to also advance in terms of artificial intelligence. And we all know that a lot of the Chinese tech stocks were trading at low multiples versus the US. And last, but certainly not least, they can look to stimulate domestic consumption. In the middle chart here, I've shown the savings rate versus the US and the UK. Although we don't expect the savings rate to reduce to this level, we have seen quite a lot of slowdown in terms of domestic consumption. And we expect that the right policy initiatives could really pick up your savings rate in China. Then talking about some of the commodities, these new age commodities, everyone speaks about the demand and what's happening on the demand front, and we think that the supply side is often overlooked. If you look at new age metals like lithium, nickel, cobalt, we've seen significant capex going into some of these new age metals, and people have actually been disregarding what's been happening on the supply side. Copper has been a little bit different. Reason being is high-quality copper deposits are quite rare and less abundant, so not a lot of significant capex has gone into copper, so we remain quite constructive on the copper theme and its role in renewable energy. And then last but not least, iron ore and thermal coal. This is the unloved sector that people have been talking about. Not a lot of supply has gone in those two, so prices actually remain quite supportive on thermal coal and iron ore, and this is quite constructive for the next 3 to 5 years. Then how does this impact on SA as a whole? We think that there's 4 key points to look at when we're looking at our SA equity from a macro perspective. Private sector participation and load shedding, and improvements on that front. Global macro, which I've spoken to, and capital flows. And last but not least, the SAR policy stance. We were quite surprised that 2 members had actually voted against a rate cut. So we know that the SAR policy stance is quite conservative, similar to what we're seeing on Canada. They've cut their rating cutting cycle given the inflationary pressures and the tariffs. Similar to what we've seen with the South African Reserve Bank, quite conservative on the rate cuts front. But from a global macro perspective and capital flows, we expect this to track in terms of the domestic economic agenda. As growth continues to pick up and they've got more confidence in the South African economy, we expect that capital flows will continue to improve. 2 out of 4 of these would actually be a good year for South Africa. If we manage to get only 1 out of 4, we're actually not seeing quite a lot of improvement. So we need to see more private sector participation. You have seen improvement in rail volumes, but we need to see quite a huge kicker and investment going into Transnet for a pickup on the South African front. So SA valuations continue to look cheap. If you compare them to our EM peers and compare them, of course, to the global valuations, but from a exchange rate perspective, when we look at it versus commodity-linked peers, we actually thought post the GNU, quite a lot of outperformance has actually already happened in the currency. So we actually thought the currency was quite representative of the economic fundamentals happening in South Africa. A lot of people were still thinking it's quite undervalued, but we thought it was quite fair going into the start of the year. How does this then impact our story in terms of SA Inc.? You'll notice since Jan last year till December, we went and really reduced significantly some of the exposure to your retailers, as I mentioned, and some of the bank, we made strategic shifts in the bank holdings. So from a South African Inc. stock perspective, we peaked at around 65%. We're closer to just under 50% in terms of our SA Inc. exposure. Resources, as I mentioned, which areas we're quite constructive there on, with gold miners still being slightly overweight in December. And then the other themes talk to your technology, tobacco, and telcos. If you look at the sectors, we're quite underweight. I'll highlight just the 2 underweights: PGMs, overweight beverages, and diversified miners. And so those 2 sectors talk to what we're thinking in terms of themes. In terms of our top overweights, although we're quite neutral on banks, we upweighted our exposure to ABSA ahead of the trading statement. Quite a lot of negativity was priced into ABSA with management changes not happening over the last 7 years, quite a lot of management shifts and changes. So we actually got into ABSA just ahead of the trading statement as an overweight, and luxury also being quite underweight. Just to talk to our long-term outperformance, I mentioned it as one of the key differentiators. If you look at the SA equity, I'll just highlight the fund performance. Over 1 year, we've done around 23%, and since inception, around 10%. And then you can see the other funds, our multi-asset funds and our equity funds.
Morning, ladies and gentlemen. I'm Charles Gous from Battelier Capital. I know I'm standing in between you and tea time, and heard a couple of rumbling stomachs as I walked up here, so I'm sure I'll be held to my 15 minutes. Today I would like to touch on Battelier Capital, who we are, where we came from. I want to delve into our investment process, and I'll finish up with a slide just on SA equities. So Battelier Capital was founded in 2004 as a hedge fund management company. We've got an experienced and stable team that will be up to 17 people by the end of May. And the important message there is that all the key individuals that's been involved with the business since inception and managing the funds are still involved and active on a daily basis. We've got a sound long-term track record. All of our different equity-centric mandates have outperformed their benchmarks since inception. We're an entrepreneurial business, we're nimble, we're flexible, we can quickly move on new information and make decisions quickly. We're not a large AUM business like the large traditional sort of managers, so we can have differentiated holdings, and given our size, we can access the broad spectrum of opportunities available on the JSE. We've got a focus suite of equity-centric products that we manage, and we all manage all of these products using the same investment process. And today I want to touch on our investment process a bit, and that will be on the following couple of slides. So our process generally favors companies with predictable earnings, growing earnings, strong cash flows, low capital requirements. We like these businesses to be managed by credible individuals that generally do what they say, and we like to acquire these businesses at reasonable valuations. So when we interact with clients, a lot of the conversation is usually around the quality of the businesses that we hold in the portfolio. And as I say, like beauty, quality is in the eye of the beholder. So we'll go through an example here and see if you can see our viewpoint on some of the companies that we like. We'll start off with a slide on total return composition for 2024. So total return is your dividend that you receive, the earnings growth out of the company, and the change in the valuation multiple, the PE, be it up or down. And that change in valuation multiple is the grey section of the bar charts that we show you in the chart. And it's fair to say that companies leveraged to the SA growth improving in the next couple of years saw an upswing in the valuation multiples in 2024. That will be the 4 businesses on the left-hand side. And they now need to deliver on these expectations in the year ahead, or valuation multiples will contract again. The 4 companies on the right-hand side, as an example, is high-quality businesses that we happen to own in the fund and have owned in the fund for quite some time. And you can see there was very little benefit there from a valuation re-rating in 2024, even though these companies delivered credible results from an earnings and dividend point of view. And Bidcorp on the far right actually grew earnings by 15% for their June 24 financial year, yet the valuation multiple contracted by 15%. So for this example, we're going to look at the 2 extremes on that previous chart, Foschini and Bidcorp. Foschini's share price increased 51% in 2024. By the end of December, the valuation multiple on a forward basis was 14.1 times, well above its long-term average. And we would argue expectations for the company was high coming into 2025. Similarly, if we look at Bidcorp, the valuation multiple contracted to 15 times by the end of December 2024, relative to its long-term ratio of 20 times. And again, we would argue expectations was low at that particular time. So we'll use this example to look at the different quality and the fundamentals of the company. We at heart, we are fundamental analysts. We like to look at the details of a company, the long-term shareholder generation capability of the company. So we'll focus on 3 key areas: free cash flow, capital allocation, historical execution. Free cash flow, some say Elvis is king, others say it's cash flow. There's a couple of derivatives of that saying. Capital allocation, what did the company do? What did the company's management do with the capital available to them? And the historical execution is how did they apply that capital, and can we see value add for shareholders over time? So in the first slide, we're going to look at the free cash flow of Foschini relative to its headline earnings. The headline earnings is the bars in red. Free cash flow is the bars in blue. And you can see that Foschini's got a mixed track record of cash flow generation over time, as the blue bars are consistently below that of the red bars. Alternatively, if we look at the fundamentals of the business from 2012 to 2024, on a cumulative basis, Foschini reported 30 billion rands worth of headline earnings, but only generated 20 billion rands worth of free cash flow. So simple math tells you they converted 66% of accounting earnings into free cash flow. What's further important is what did the business do with the 20 billion rand available to them? How did they generate shareholder returns, or how did they add shareholder value? Now, Foschini spent about 14.5 billion on acquisitions and growth capex, and they paid out around about 13 billion rand in dividends. It's interesting to see that they had 20 billion available and they spent 27 billion. So where did the rest of the money come from? It came from debt. And we can see from Foschini's debt profile, their debt levels have increased from 2012 to 2022. And what was interesting when the pandemic hit, the balance sheet was a little bit stretched. They had to do a highly dilutive 4 billion rands rights issue. And we can note that the debt levels are again increasing as they've continued with their highly acquisitive growth strategy. And that's a warning sign for us. But did they add value? The 15 billion rand that they spent, how did it benefit you as a shareholder? Headline earnings per share has largely grown at 2% per year over the last 10 years. What is interesting is that the sell side expect earnings to now grow at 14% a year for the next 3 years, and we think that's quite a questionable achievement for them. On the back of that, the operating metrics have also deteriorated. So return on equity and operating margin has largely been in a declining trend, and we can't see the benefit of the growth capex in the acquisitions in the numbers. So you're familiar with the slides now. We'll run through it the same way for Bidcorp. Firstly, we can see a much more consistent financial performance from Bidcorp in respect of their free cash flow generation relative to headline earnings. This indicates effective working capital management at the business and a favorable working capital cycle, and it supports the quality of the earnings that the company reports. If we do the same exercise, they reported 48 billion rands worth of earnings over the period from 2013 to 2024, and they generated 42 billion rands of free cash flow, so an 85% conversion for Bidcorp. So what did Bidcorp do with the money? Similarly, the 42 billion rand they had available, they only spent 36 billion rand. 19 billion went to grow the company through acquisitions and growth capex, and they paid dividends out of free cash flow available to them, to their shareholders. I think it's also interesting to note how Bidcorp's net debt profile moved around about the pandemic. They managed to reduce their debt quite significantly. Now remember, this is a business exposed to the hospitality sector, restaurants, hotels, you can think all of those kind of businesses really just shut down in the pandemic. They reduced their debt during that period. They didn't require a rights issue, and they've actually managed to hold their debt at very conservative levels at 0.2 times net debt to EBITDA. Similarly, the operating metrics have been improving over the last couple of years. Operating profit has increased, ROE has increased, and ROE currently at 19% is actually very benefit. So we see the benefits in their numbers of the investment into scale and the investment into efficiencies, driving better profitability for the business. And that's played out in the headline earnings per share growth. So this business grew earnings by 14% compound over the last 10 years. There's a handful of JSE-listed stocks that's grown their earnings above 10% over the last 10 years, so it's quite a rare occurrence. It makes you question again why the valuation derating. Expectations are currently for about 9% earnings growth in the years ahead. We'll be quite happy with 9 or 10%, given it's largely hard currency earnings that they report. So if we summarize the two businesses from a cash conversion, debt profitability, and forward valuation multiple. Sorry, somebody needs to answer that. Foschini's got a cash conversion of 66%. We don't think that's particularly great. Debt levels have been elevated and have required a rights issue in the past. Profitability ratios are going the wrong way, yet it's trading on a forward P of 14.5 times. We compare that to Bidcorp at 85% cash conversion ratio. Debt levels are low and under control. Financial metrics are moving in the right direction. And given its high level of ROE, without a lot of debt on the balance sheet, we think a one-turn difference in Bidcorp versus Foschini certainly adds to our qualitative argument that Bidcorp is a much higher quality business. And that points to our investment strategy and the way with which we look at companies. So we won't sell Bidcorp in a year just because it might be out of favor. As long as the business continues to deliver earnings growth and high quality earnings in the case of Bidcorp, we think this business will do very well over the next 3 and 5 years for investors in the fund. So one slide on the domestic outlook. SA GDP growth is expected to improve from very low levels. I think the general sort of forecast at this stage is for 1.5% to 2%. A lot of us sort of still got a wait and see approach to it. We really want to see that print in that number, and I think that will get the market going. But there's nothing to really celebrate. I mean, we need significantly higher growth to tackle the issues that we've got in the country. So given that backdrop, the SA Equity Fund is still positioned for an improving South African outcome, with about 60% of assets allocated to the domestic-facing companies, but still a reasonable 40% to offshore earners. We think domestic valuations, both the bond and the equity markets, remain very attractive, and there's actually been quite a bit of weakness in the last couple of months, especially in high-quality companies that can be acquired. Within the fund, there's fund-specific opportunities, where we think the intrinsic value of the companies are significantly higher at where they're trading at the moment, and that can deliver good returns in the period ahead. I think the most disappointing part for us in the latter couple of months has really been the South African Reserve Bank policy. I think a couple of the previous speakers also mentioned it, but we've had 75 basis points cut in interest rate. That's lagging the US, it's lagging EU. It's a very, very restrictive monetary policy that we've got in place. And that's a hindrance to growth, it's a hindrance to investment. It's a high hurdle for new investment into the country, into projects and the likes. Inflation is firmly under control, even if we move from the 3 to 4% level that the Reserve Bank is expecting. We think that gap over the last how many years that we've got on the slide there is really just extraordinarily big and a big hindrance. So that's the one part that we would have liked to see over the last couple of months, just to get the SA consumer out of first gear, and it's really an opportunity to support economic activity in South Africa in the short term. Thank you very much. In closing, we've got a deep understanding of the local equities at Bateleur. We've got a lot of experience with the same people managing the funds. We've got more than 20 years of history to show you, and we look forward to good investments in the South African market, given the very low valuations and the quality of the portfolio. Thank you.
Right, before we run off for tea, a couple of very short questions. I just want to check from the audience. Anybody a question for any of the presenters? Right, you really want to get to that tea break, don't you? All right. Quick questions. All three of you run multi-asset flexible funds. I know we focused on SA Equity now. You all sound very bullish on SA Equity. There was a couple of really, really good examples. Very quickly, on your multi-asset flexible funds, where are you on SA Equity? Underweight, overweight, why? To me, go first.
We actually still slightly overweight SA Inc. but what we've done at the start of the year is everyone was talking about bonds, and we thought bonds did really well last year. We've moved some of our nominal bonds into inflation linkers. So we think people aren't concerned about inflation going forward, and you had quite a nice low base last year. So if inflation starts to tick up, that's where people will be concerned about in the next medium term. So we've moved some of our nominal bond exposure to inflation linkers, but on SA Equity, we're still quite overweight.
Roger.
No, we also marginally overweight South Africa. So in our flexible fund, we're about 54%, our benchmark's 50%, so we are marginally overweight there too.
Sure.
We're largely in line, but that is higher than where we were a year ago. But also the in-line composition looks significantly different to that of the market.
To me, you spoke to gold. Thank you very much for that. You spoke to gold, like gold. Gold price, phenomenally high levels. Gold miners lagged until Jan, and then Jan, it was just boom, catching up to the gold price. You overweight gold miners. Isn't it too late, too little too late? Didn't the catch-up already happen, or are you still like gold miners going into 2025 or for the rest of the year?
We still like gold, but the gold miners specifically, it's hard to find areas of value where you actually think that the gold miners are really using capital allocation as the 1% spoke to quite well. So in areas where we think from the gold miner perspective, we're going to see quite negative results, we will reduce going into the start of the year, but we're still constructive on the gold theme overall. So we are switching a little bit from gold miners into the actual GLD stock.
Roger, I know you don't play themes, but your views on gold?
Well, gold's been exceptionally well. I think, ex-post much easier to read because everyone was saying with high interest rates, the opportunity cost of gold is is negative. Instead, it's gone up. Also the Chinese central bank, the data is very sketchy, so hard to get that data. Obviously, it's confidential. I think we're approaching a really key technical level, 3,000. So if you remember, gold in 1980 hits 1,000. It struggled really to break through. It took 17 years to recover back to 17,000. 2,000 was another key resistance level. Now 3,000, I think that's going to be a real key resistance level. So if it doesn't break through, it's probably time to get out then.
Let's see what happens there. Charles, very last question. And I mean, very often when we construct portfolios, we get a couple of portfolio ideas. Some of them work, some of them don't work, but overall we're moving in the right direction. When do you decide in your portfolio, you showed two very good examples for Shini, Bidcorp, you're holding Bidcorp, I understand why. When do you decide to cut a position in the portfolio, or do you just keep on holding?
Largely when the news or the fundamentals change. I think we're quite quick to act if something change in the company or something change in the investment case. If a business like Bidcorp, like I showed you, prints 15% earnings growth, pays you a dividend, they actually had an operational update after that as well, and we expect them to print about 9% earnings growth this week. I think they report tomorrow morning. So nothing has changed, So when nothing changes, you hold on to it. When information change, we will swiftly change the portfolio.
And no big changes in your portfolio recently? You're still holding to some of the big counties you hold?
No major changes, no.
Fantastic.
Thank you.
Ladies and gentlemen, that's all we've got time for, unfortunately. But they are going to stay for tea. If you want to engage with them, please do so during tea time. And we're going to keep tea until 11:20. We'll ring a bell outside as soon as we're ready for you. Thank you so much. Appreciate your time. Right. I think most of us are back in the room. Thank you all for being on time again. Really appreciate it. Our next session is on flexible fixed income funds. We had the bond guys this morning. Some of their views, like they said, glass half empty, but we'll see how we follow up on that. If you look at SA fixed income funds as at the end of Jan 2025, some of these multi-asset fixed income funds gave clients inflation +9. I mean, wherever have you seen numbers like that? And some of them even beat some of the global equity funds. But what's ahead for 2025 with the rate cutting cycle slowing? Can investors expect similar things, or do we need to be more risk adverse? Here to share their expert views, Melanie Stockett from Laurium Capital. Melanie, thank you so much for joining us this morning. She'll be first up and followed by Nolan Wapenaar from Anchor Capital, and then Simon de Plooy from Corian Capital. Melanie, thank you so much for being here.
Hello, good morning, everyone. Such a pleasure to be here with you today. Thank you so much to BCI. What I thought I would do today was I was going to start with the big three themes, or the cross currents that I see impacting the global and the South African fixed income landscape, so the universe that we construct our multi-asset portfolios within. And what those themes currently are, in my mind, the most important ones are firstly, what's happening in US bond world. So what's happening to US interest rates and bond yields under Trump's second reign. The second one in South Africa, how are we managing or navigating the political stage, this new governing arrangement that we have, is the centre going to hold? And then at the same time, the rising geopolitical risks that we are being faced with. And then the third aspect, which is counter to those trends, is where are we on South Africa's structural economic growth journey? And is the direction of travel still positive? So when I think through this year, coming out of the COVID crisis, the word I think all of us used the most was unprecedented. We had unprecedented lockdowns, unprecedented rise in global inflation, unprecedented fiscal policy, monetary policy thrown to sort out the crisis. And just as we thought we were coming out of the woods, we then had the US elections towards the end of last year. And honestly, what could possibly go wrong with that for us as fixed income managers? So when I think through this year, the word that I suspect we're going to use the most is that of unpredictable. So when we're thinking about forecasting probability of outcomes, distributions, the tails on the distribution are going to be much fatter in this type of environment. So what are the types of things that we're thinking about? You know, Trump coming in, he's got this policy trifecta of tariffs and immigration together with deregulation and tax cuts. We've got no idea of magnitude, we've got no idea of sequencing, but we know they're going to have an impact. They'll impact growth, both US as well as global growth, and they'll impact inflation. They're also increasingly looking to impact US soft power. So cutting off aid, attacking trading partners, key trading partners, breaking down foreign alliances that have been built up since the Second World War, all of these things are going to have some sort of impact, right? The two things that we are certain about as we enter this year is firstly that we're going to have policy uncertainty. That's a given. I don't even think Trump himself knows exactly how all of these things are going to land. And then the second one is we're going to see volatility. Fire, then ready, then aim. So it's really, you know, Trump's approach to policy making is it's impulsive, it's aggressive, it's shoot first and sort out the details later. If it's legal or not, you know, what does that really matter? So volatility absolutely going to be one of those watchwords of the year. So is this uncertainty already starting to show up in indices? What I've shown here is a trade policy uncertainty index. It goes all the way back to 1960. And really, this is quite a simple measure. What it does is it takes the occurrence of the words trade policy and uncertainty across the 7 major US newspapers, and it plots that into an index. And you can see that the recent spike we've seen, so much more than Trump's first term, and certainly at unprecedented levels. And why is there so much uncertainty? I don't really need to sketch this out. We understand the drivers. But firstly, we don't even know who tariffs will be levied on. So is it just going to be China? We've already seen that now. It's out of the starting blocks. China's certainly the extra 10% levy, and that was the focus of the first administration. Or is it going to be the large neighbors of Canada and Mexico at the moment? They've had a little bit of a short-term reprieve. Does that come back on again? Is it going to include the massive trading blocs of the Eurozone as well as the UK? Is there going to be a universal tariff applied to everyone? And most importantly, is the rest of the world going to fight back? Are we going to see reciprocal tariffs? If you punch me on my nose, am I going to punch you back? Are we going to see some sort of full-scale trade war? So what we can absolutely understand now, relative to the first term, is that the scale of the tariffs is so much wider, including many important trading partners, as well as a much, much wider range of goods. Right, so how does this all impact, my departure point, which was the US bond market? We've got so many factors pulling in different directions at the moment. So when I think about US bonds, there are really 3 key drivers of US bond yield direction. The first one is the short end of the curve. So what is the Federal Reserve going to do with interest rates? We know we are on an extended pause right now. What's the next move going to be? Is there going to be a cut, which most people are expecting? There are 2 25 basis points cuts priced in by the end of the year, but that waxes and wanes depending on which day of the week it is. Is the next move going to be a hike? And importantly, are other global central banks going to be synchronized? How is that going to impact our SARB MPC? If we've got higher for longer from the Fed, is our SARB going to be hamstrung? Yes, absolutely. And driving this decision is going to be the second big driver, which is US inflation. So tariffs, of course, are inflationary. If they're implemented once and it's not a rolling set of tariff increases, it should, in theory, academic theory will tell you that central banks should be able to look through that first round tariff shock. It's very different this time round. We're now sitting with a situation where inflation expectations are going to answer the question of how the Fed can respond. If inflation expectations remain well anchored, of course the Fed can look through and focus more on the growth impact. But inflation expectations start to become unanchored and start to rise, and we have seen some worrying trends in recent prints that are moving in that direction. Essentially, is the muscle memory after such a big rise in global inflation in recent years that corporates can just pass price increases on? Is that going to break inflation expectations link? That would give the Fed a lot less latitude to be able to look through, and they'll have to focus on inflation. So we're not calling for further interest rate hikes, but you can't take it out of your probability distribution of fatter tails this year. And then the third key driver, which is what drove sentiment in the fourth quarter of last year, so sort of from September onwards, and the first couple of weeks of this year, was this idea that we needed more term premium in the US market. What is term premium? It's really compensation for uncertainty. Why do we need compensation for uncertainty as US bond investors? It's because of this picture. US bond yields, the fiscal position in the doghouse, And why? What we've shown here, the bars show you the fiscal deficit as a percentage of GDP. And what you can see there is that that can spike in times of crisis. So the government can spend a lot at a time of crisis to bring the economy back on track again. And we saw that post the global financial crisis, and we saw that into and coming out of the COVID crisis. But if you have a look at the light blue bars, that's the forecast, those numbers stay eye-wateringly high for as far as the eye can see. That's not normal. And you can see the impact on US debt to GDP, which is the red line at the top. That increases quite alarmingly if those forecasts did materialize. Obviously, the chatter in the last quarter and then the first 2 weeks of this year was, what if we see a Truss moment? What was a Truss moment? Liz Truss, who was Prime Minister in the UK for, I think, 49 days, in that short period of time presented a mini-budget, which showed large unfunded budget tax cuts, and the bond market freaked out, completely destabilized. Bond yields rose significantly. And so we obviously have to be sensitive. Is there going to be a Truss moment in US bond markets? And that type of environment happens, and on the incidents that we've seen in the past as well, when the market loses confidence in the government and they think that they're acting recklessly. So that's what happened during the Truss crisis. Things have calmed down in US bond yields of late, since the middle of January. And why? There have been two key drivers. The first one has been Elon Musk and his very publicized, and we can debate that for ages if it's going to even impact anything or not, but a focus on cutting government expenditure. And then secondly, US Treasury Secretary Scott Bessent, who's come in, is very focused on 10-year yields. So not trying to strong arm the Fed and cutting interest rates, but focus on the 10-year yield and very aware of supply and demand factors. So that has meant that bond yields in the US have stabilized of late. But let's just zoom out for a second. Let's put things in perspective. This is the US 10-year bond yield going all the way back to 2005. We can see that bond yields are much higher than they were in the US, back to pre-global financial crisis levels. And everyone's aware of the fiscal risks, so to some extent that could be priced in. And interestingly, of course, yields can move higher and could move higher quite quickly. But there's almost a self-limiting force that's coming in here, that with the Fed higher for longer and US yields higher for longer, it does start to increase the risks to economic growth being under pressure. And we know bond yields are such a good hedge against data disappointment. So you could see more tension supporting yields at this level than perhaps you would have thought at first glance. Right, moving on to South Africa. So those key drivers that we were discussing. First of all, you can't wake up any morning without reading a News 24 headline screaming at you that the GNU is disintegrating. This is the end of the GNU. And yet somehow we're still all standing and still together. Absolutely, there were always going to be some teething problems with this. You have to figure out how to work together. Political parties, very sensationalist. We've just put it down to seasoning, essentially. We've had quite a few tests, Bellable, Appropriation Act, NHI, all of these are important tests, and then we saw the budget last week being postponed. Don't get me wrong, as bond investors, we don't want to see postponement of the budget. We've never seen that before. It does unsettle us. But if we have to look at the lesser of two evils, the thought of going back to the table, we don't know the new rules of people working together, renegotiating something that works by and large for all parties is much better than then taking it to, forcing it through, going to Parliament and having to vote on it. If we have to take all the noise out of the equation, when we think to, please, let's get a budget on the 12th of March, but when we look at that budget on the 12th of March, what's so important to us as bond investors or fixed income investors, multi-asset income investors, we want two key tenets to be met. The first one is debt sustainability. We don't want debt GDP to be allowed to rise further, and we want to see a budget that has some sort of growth implications. We need growth to lift. So if we cut through all the noise, regardless of what the ultimate mix is, of course the detail is important, but those are the two things that we need to see met. And encouragingly, during the course of last week, all the political parties that disagreed and were vocal, even the ANC ministers who were, all put those two as very key objectives that had to be met in the negotiations. So that certainly does give you some comfort. The second rising factor, geopolitics. How do we handle ourselves on the global stage? We don't know the timeline of this, right? We don't know exactly what the US wants to extricate from us as concessions. We know we're early in the process, but we do expect elevated noise throughout this time. I think it's incredibly useful that this is the year that we have the G20 presidency. Now, the main reason for that is that we get to sit around the table and engage with our key counterparts. And sorry, I did bring a crib note along with me because I did a quick look at Ronald Lamola's Twitter feed, X feed this morning. And it was a G20 foreign ministers meeting last week. And he had, obviously, all the big group meetings, but he also had bilateral meetings, so one-on-one, face-to-face meetings with the foreign ministers of Australia, France, Germany, Turkey, the UK, Spain, Canada, the EU representative for foreign affairs, and then our BRICS counterparts, Brazil, Russia, and China. So that just shows you that we get to be around the table and tell our side of the story and hopefully be able to maybe dispel some of the misinformation that possibly could be raised. So that, I think, is an asset, and I think that's opportune timing for us. But what about the economic growth recovery? That's going to come in 2 stages in South Africa. The first one is going to be the cyclical recovery, lower inflation leading to lower interest rates, a little bit of boost from 2 parts, it's temporary and near term. But that buys us some time with growth lifting for us to do the difficult stuff, the structural reform journey, which is what we focus so much of our energy on as analysts, and we definitely see us still being on track. So what do we think about when we think about structural reform growth? We think about the big potholes that have been holding growth back in South Africa for so many years. It's been the damage caused from load shedding. It's been not having a functioning port and rail system. It's not having good municipalities and feeding through to water infrastructure fears. Those have all impacted business confidence negatively. What's different now that we haven't seen in the past is that in each of these areas, we obviously have Operation Bulandlela, Economic Reform Task Team, focused specifically on fixing these sectors, but they've invited the private sector in. So it's really, the image shows this big public sector and the private sector working together. What does the private sector bring to the table? They bring capital, funding, investment, and they bring skills. And they're actively being engaged to bring those to be part of the solution. And that's key to us. So when we're thinking about structural recovery, it comes through itself in 2 phases. The first one is the investment that comes in to fix these potholes. And the second one is that as these potholes get fixed, all of these issues that we've discussed, it gives businesses confidence then to invest further, to increase their manufacturing capacity, to expand, and that brings a second wave of growth and jobs. What does this mean to us as bond investors? It means that if we have a stronger economy, a bigger economy, we can generate more revenue from that economy without having to raise taxes. It fixes our fiscal position, and the litmus test will be it will lift our sovereign rating over time. So if you read through all the noise of rating agencies, they focus on 2 things: stronger economic growth, which repairs the fiscal path. Those 2 things would buy us a rating upgrade or 2. So that's what we're watching carefully. Right, I'm just going to summarize very quickly. I've run out of time. But in times of uncertainty like this, how do we then approach asset allocation within a multi-asset income fund? How do we build defensiveness? What we do is we've got to think through all the different possible scenarios. So it could be a scenario of US exceptionalism this year. Maybe. It could be SA exceptionalism. Perhaps. Maybe we get some growth runs on the board. All of these things are in play. But the golden rule at times of uncertainty is that the risk premium needs to be attractive to invest. So we don't go chasing things. We don't go and chase SA credit spreads at incredibly low levels. We don't go shift a big proportion of our portfolio into US credit when US credit spreads are so unbelievably tight. You wait for those opportunities to come to you. Let volatility be your friend. You look for opportunities that are still likely to re-rate. We saw a nice rally in bond yields last year, but there are lots of pockets within our fixed income universe that haven't re-rated yet, and we're going to be paid to wait for those re-ratings to come through. You obviously want diversification to be an asset. You want it must be an and year. You want nominal bonds and inflation-linked bonds. You want fixed rate notes and floating rate notes. Diversification is your friend, and you want to be flexible and agile. So smaller boutique managers who can move their duration around very quickly are where you want to be. Luckily, we as fixed income managers in South Africa, we're trained for this. We are very used to generating good returns out of challenging fixed income markets, and we're very confident that this year we're going to find lots of opportunities to do the same. Thank you. I'm going to stop there.
Thank you very much. Thank you, Melanie. So a challenge with presenting here, and it's wonderful to be back, by the way, is always it's the first presentation, so I don't know what the person before me is going to say. In this particular case, it actually dovetails very nicely with what I've said, so it's a lovely intro, so fantastic. But by way of introduction, my name's Nolan Wapner. It should be on the screen somewhere. There my screens are. It's actually not on the screen. But nonetheless, I am Nolan Wapner, very confident of that, and I'm the head of fixed income at Anchor Capital. In terms of what I want to talk about, I want to start by talking about what is flexible income. What are we actually trying to do? And the metaphor I'm going to use is to compare it to a baker baking bread. And what we really are trying to do is mix a set sort of number of ingredients, and I think Melanie mentioned a lot of them. You've got your fixed rate bonds, your floating rate bonds, your inflation-linked bonds, etc. And we're all mixing these in, and the idea is to bake a bread that gives us a specific sort of flavor and style of returns to our investors. What are we trying to achieve for investors? Actually, a relatively stable return within flexible income. Nobody wants a flexible income fund that's up 10% one month and down 10% the next. And we are trying to achieve a return that is significantly higher than what you would get in money markets. So that's really the sort of golden objective of what we're trying to do. And within that, we're actually all combining very, very similar components. I don't know what Melanie's fund looks like right now, but I would imagine it's got very similar ingredients. Within that, as portfolio managers, what we're then doing is sort of specializing, if you want, in certain things. So some bakers are very good at finding raisins to put into their bread. Some might find other ingredients. At Anchor, we're actually very, very good at finding the right credit investments, the right credit opportunities, and managing around those. So that's kind of who we are. Now, within this objective of trying to provide a relatively stable outcome for our investors, it is actually very difficult. So what I've got here is just some of the pronouncements from Donald Trump in his first 3 weeks in office. Why just his first 3 weeks in office? To be honest, because I ran out of slide space. And he kept going. But, if you take note, and I think Melanie touched on a lot of this, 1st of February, we got tariffs on Mexico, we got tariffs on Canada, the currency markets, tariffs move currencies tremendously. Currency markets all over the place, oh my goodness, I've got a hedge. On the 2nd of February, he comes out, goes, yeah, sorry, only joking, guys, tariffs reversed, and like all your hedges are now underwater. And that's the type of environment we're in. So what does that mean for us in the financial services industry? The first thing it means is we're going to be psychologists. We're going to be psychologists to our clients. Volatility is inevitable in this environment. You are going to see more ups and downs than you previously did, more ups and downs than we've been accustomed to. We need to handhold our clients through this. The second point I would make, though, is that in this volatility, you're going to see opportunity. It is absolutely fantastic. Every day I sit in my office and I've got somebody coming into the office. Have you seen how cheap this is? Have you seen this opportunity? These are discussions I used to have once a week. Suddenly the markets are throwing these up every day. You've got to be selective, but the opportunities are out there. Looking at flexible income, I just want to talk about one thing Anchor got right. So 6 months ago, I did a presentation on our webinars where I said, what is the opportunity set in South African government bonds? And very quickly, what you've got here is the breakdown of the fair value of the SA bond. So at the bottom, you've got the US 10-year bond. You add to that the green line, the credit spread. You add to that a sort of currency mix. Don't worry about the detail. But the point is, you add all of those up. That actually is the fair value of our bonds. The little brown line right on top is actually where our bonds were trading. And the point is that we'd identified and gone out and said, bond yields are actually too high. There's an additional premium that the market was pricing in. It was a sort of political risk premium, and that you had an opportunity to invest and to monetize that premium. So that was the presentation we did 6 months ago. And if I extend that graph and say, well, what happened? Exactly what you'd expect. That political risk premium has actually priced out of the market completely. And as investors, we get excited. Here's an opportunity to earn some excess premium, everything that Melanie spoke about. How do we do it? Well, the first obvious answer is, let's just go and buy the bond. So you go and do this. But the issue is you're going to end up with a chart, something like on my left here, which is a volatile chart. Okay, your bonds did very well. They did very well because that political risk premium compressed. It gave a big gain to South African bonds, but it was a bit all over the place. And at times you could have had 3-4 months where this position was underwater. it made sense for certain portfolios. Anchor Bond Fund went and bought these specific bonds to actually capture that premium. Did very well out of it, top quartile last year as a result. So that was how we monetized it. But the issue is we're now talking about a flexible income environment, and if we put that sort of return profile into a flexible income fund, our investors get uncomfortable. The volatility is just too much. So we have to find another way of monetizing that opportunity. And we did that via structured bonds. So what I mean by that is essentially we go to a bank and we chat to the bank and we say, look, we have identified this particular bond that is appealing for us, and specifically we want to isolate this political risk premium component, and in our case we also isolated the credit spread. And we want to identify a way of buying the bond, hedging out that market volatility, and hedging out the pieces of the bond. Remember that breakup? We can actually go and hedge out each individual component if we want. So we do that. And we say, yeah, we'll take that component because it's looking cheap. We'll take that component, it's looking cheap. Those components, to be honest, they're too volatile. They could go anywhere. We don't want those. Bank, go and hedge those out. And the bank will go into the market. It will actually go and put those hedges on for us. Then what we will do is basically buy a financial instrument from the bank that gives you the net exposures that is just what you want. By doing that, we were actually able to create those structured notes that gave you that nice, solid, straight red line. And what's interesting about that red line is people talk about credit spreads in South Africa, and credit spreads in South Africa are quite tight. If I lend money to a bank right now, I'm probably going to earn SAIBOR, which is kind of the floating rate. Think of it as the repo rate for all intents and purposes, plus about 1%. That's where we can lend money to a bank. If I go and lend it to Growth Point, I can maybe get repo rate plus about 1.1 to 1.3 over a similar period. We were able to go and lend money to our SA government, lock in SAIBOR plus 2%. A significant yield advantage over what other people were able to see, over what they were able to generate. And that has been a fantastic boon for our portfolios. Now, what's interesting is as this has taken place, obviously that premium has dissipated within the market. So, as we sit here, our portfolios have locked in these yields of, repo plus 2. The investments are still sitting in our portfolios at about those levels, but there's no more opportunity for that. And we've had to sort of scrounge around, figure out where the next pocket of opportunity is. We've been finding the opportunity has been in a couple of South African sort of names that have listed bonds offshore. Recently, we lent a lot of money to Naspers, actually, in dollars. And again, we hedged out the currency risk, we hedged out the market volatility and all the rest of it, and we've ended up with just the component we want. Significantly outperforming what we could earn in the domestic markets. So we've been doing a lot more of that of late because that is where the opportunity set is for flexible income. In looking at that, what I will say is, Anchor has a bit of an advantage. I worked previously at Deutsche Bank. I actually ran their desk that did all of these hedges in Europe for a couple of years. So we're very comfortable with it. We've got a good understanding of it. And the point you've got to watch out for is a lot of the banks will do this, but they won't actually hedge out the risks. They'll just hide the risks. And the problem with a hidden risk is it comes back to bite you later. So from that perspective, we've got very strong policies, very strong views on what we will do, what we don't do, frustrate the heck out of banks, but it works. And we've been able to generate this portfolio that is significantly superior to what you would get by just investing in credit. So summarizing it all up, why Anchor? Our flexible income is 10 years old, give or take. It's got a decent track record. Please, if you do look at our track record, look at the C-class units. We've got legacy A-class units, which have a very high price, so don't, and as a consequence, it distorts all the graphs. C-class, freely available to everybody. Please, if you're investing with us, invest in the C-class. And it is competitive. It has delivered what it's supposed to. We have been able to do it by looking at it at the market slightly differently, by blending in subtly different ingredients into our flexible income. This means that we blend very nicely with the other components of your flexible income for clients because we bring something different. We are absolutely positive on South Africa. We are absolutely leaning into duration in South African assets. But our core strength has been our ability to tap dance through credit icebergs and to spot these opportunities to create a bit of extra structural value. In terms of what do we bring, we're nimble. Anchor is still small enough to be nimble. We can do a structured deal like this, and it's big enough to make sense for our portfolio. It's big enough to add value, to be meaningful. And why Anchor? We're big enough to matter. We get the phone calls from the banks when there are opportunities. We typically get them first, or one of the first phone calls. We've been asked to underwrite various bonds, etc. So we're able to sort of plug into the opportunities, but look at things a bit differently. So with that, I'm going to wrap it up there, a few minutes early, but I'm going to hand over to Simon just to sort of bring it sort of close to the flexible income side. Simon, thank you very much.
Thank you, Nolan. So I'm up third. This is our first time in Pretoria. Corin Capital joined the BCI Manco in June of last year. So we're quite excited to be part of these roadshows. As Nolan introduced me, which was a first for me, I'm part of our investment team. I am head of asset allocation and fixed income. And Corin Capital is a multi-strategy house. We've got about 18 billion in assets under management. And we've got it across the retail and institutional space. So apart from the retail funds and the fund I'm speaking of today, we also actually manage some assets for some of the large corporates in pension fund mandates. I'm here to speak specifically about our income fund. And I think in contrast with what Melanie and Nolan did is I'm going to focus on a specific opportunity within the fixed income space. And then speak more generally about the fund. I think it's a bit of an intro for everybody into our offering, so I'll also just have some general comments. So one thing we focus relentlessly on in this portfolio and in this fund is being as diversified as possible. I think in the South African space in fixed income, it's actually quite difficult, to get a truly diversified portfolio. We haven't got a lot of corporates. It's not like the US or Europe where you've got loads and loads of companies you can invest in. So in South Africa, your fixed interest space really is dominated by the government and by the big four banks. And the real challenge is how do you diversify this as much as possible? Now, one way to do that is to look at your asset classes. In terms of our track record, the fund's been going for close to for over 6 years now, and we've persistently been able to beat cash. Our benchmark is officially cash +1, and I think that's what the minimum we're trying to achieve over any 12-month period. Now, I have to caution investors here, as I think Eugene said, inflation +9 over 12 months is not usual for fixed interest funds. So the 1 year number is really an anomaly, and you're going to see it across all the funds. And the main reason for the very good 1 year return is that we started 12 months ago, cash rates at 8.5%, which really gives you a good start. And our government bonds was at 12%. So really, if you were in government bonds, you got a 12% return, and then you had nearly a 200-point rally on the yield curve. Now, at the duration of around 6 on those bonds, that means that's an extra 6-7% that you got out of those bonds. And that's why we've seen this exceptional high returns relative to cash, and importantly, relative to where cash is now in these funds. So I think for future expectation, looking at a 3 or 5 year number is much more an accurate picture. That said, obviously, in those years where one can deliver 10% plus for investors, that is really a great outcome for everyone. In terms of our market views and positioning, I can briefly summarize that is that we believe we're at the bottom range of the inflation, that inflation is bottoming out. And as a result, what I'm mostly going to speak about today is inflation-linked bonds. We're really bullish on inflation-linked bonds. We believe they're a great diversifier in the portfolio. They've got limited downside from here, but a lot of upside. That said, we still carry a fair amount of duration in the portfolios. I just don't want to spend time on that today, and we can do that at the next presentation. I'll briefly touch on property, where we're largely neutral, but there's some still attractive yields out there, and some companies that are undervalued. And then lastly, if there's time, maybe we touch briefly on offshore, but in fact, let me finish that off. The dollar is extremely overvalued, and one can go into hours of analysis on it. The problem is South Africa risk has changed a bit. And what you're actually seeing what's happening at the moment is that, on the one hand, you've got this overvalued dollar, so you actually don't want to own too many dollars in your portfolio, offshore assets, but there's this lingering risk that just want to pop out. And what they're actually seeing in the option markets and the currencies is volatility being very suppressed, very low. And what it's signaling is that markets are not expecting the rand to move a lot. We're very concerned either way. So we're actually, buying into that optionality because we can see a scenario where South Africa, continued improvement, overvalued dollar, and the rand goes back to 17 or even 16. And we don't want to take losses on our foreign assets. Similarly, one misstep by government on Transnet or on Eskom, and we could see the rand at 20 again. And you want to benefit, on your foreign assets. So optionality is key here. But returning to inflation, that's the inflation chart over the last 5 years. And as you can see, we've put in the top and the bottom end of the inflation range, the green at the bottom at around 3% and the top at around 6%. And around 2022, we were well above the top end of the range. That was when inflation globally was very high. And right now we're sitting around 3%. And historically, it's very rare for inflation to drop lower. For us, that signals to us we're at the bottom of the range. If you also look at the inflation forecasts that the SARB is using, and this is a big driver on where inflation is going, is that, sorry, this is a bit small, so I'm going to go on the charts here. So this was their expectation, the current forecast and the previous forecast. And you can see, for 2024, they were expecting around 4% inflation, but we came in out at 3%. So way lower inflation realized than the SARB was expecting. In the coming 12 months, they're expecting it to go to 4%. Now, even if we still get at 1% lower, you still at this floor in the inflation band. So we're really going on a worst-case scenario here for inflation-linked bonds. And then the critical bit is the outlier what can drive inflation higher is your electricity component in your basket. That's an administered price that isn't determined by market forces. It's Eskom and NERSA determines that price. So this is completely out of the control of the SARB, and that's really what they're worried about. So what we're sitting with is an environment where the SARB is running very high real rates, continuously worrying about inflation, and have suppressed inflation sufficiently to remain at 3%. Now, you've got too many forces that's driving this inflation higher for it to remain there. In fact, if you now go and look at just how low inflation was over the last 6 months, you can see there's very, very little inflation in the market. So we really think that, even if this persists, that's actually the way I want to put it, is like, even if this low inflation persists, what you're seeing in the inflation bond market is that this is being completely priced in. 2 weeks ago, there was an inflation-linked auction on the Friday. The government was willing to sell R1 billion in bonds. They only sold 450. There's not enough people looking to buy these bonds at the moment. Why? Because your carry at the moment, the accrual you get in your inflation-linked bond, because inflation-linked bond appreciates as inflation appreciates, is very, very low at the moment. People are saying, no, hold on, I'm not getting paid to hold that. But that's a very short-term view, only looking at the next couple of months. And we're not getting paid to look at the next couple of months. We're getting paid to look at the next 12 months to 2 years. If you look at the performance differential between nominal bonds and inflation-linked bonds, they are highly cyclical. It's one thing that at Corian that we strongly believe in is the cyclicality of markets, and something you have to pay attention to. 5 years ago, government bonds outperformed inflation-linked bonds. It's the perfect time to lower your government bond exposure and increase your inflation-linked bond exposure. Maybe keep your duration neutral. 2 years ago, at the height of the inflation crisis, it was the right time to get out of your inflation-linked bonds. They've done incredibly well for you. They did 15, 16% over that 12-month period. Nobody talked about it because inflation-linked bonds is such a small part of the market. Exactly the return that government bonds did now for the past 12 months. And now, again, we're at this point where government bonds outperformed inflation-linked bonds. Now everybody is talking about government bonds. Everybody wants to own them. But the rally has happened. We've gone from the 13% yields down to the 12% and 11% yields on the long end. Inflation-linked bonds have lagged. And now's the opportune time to go into that underappreciated asset class. If you look into the raw numbers, you're getting a 5% real yield in your inflation-linked bonds. Let me show it on that side as well. You're getting a 5% real yield. Now, keep in mind that most pension funds' assumption is that they have to deliver inflation plus 5 for their members. So if that is truly the only thing you're looking for, and very few pension funds are, but if that's your only metric, your whole fund should be in inflation-linked bonds. Government guaranteed, inflation plus 5 guaranteed, yeah. And if you then do a bit of risk analysis on it and you're saying, and obviously we're going to keep this very simple, and you say, hold on, cash at the moment is giving me 7.5%, that's the bottom bar. Even if inflation comes in at 2.5%, and obviously this is very simple math. My fixed income bond professor will shoot me for doing the math this way. But if you do a very, very simple calculation, even at 2.5% inflation, you actually break even with cash. If you get a moderate return of inflation to the middle of the band, we end up at a 9% return. That's cash plus 2. We're well ahead of our target. And should there be a shock to the system, and that's been discussed extensively today, you can easily get to a 10-11% return on your inflation-linked bonds. So you sit here with an asset class that has got limited downside and significant upside under the right circumstances. And that's why we've meaningfully increased our position here. A brief note on property. Like I say, 18 months ago, we were very overweight property. Yields was incredibly attractive. Some property companies were trading at a 15% yield. So we were significantly overweight. That has normalized. The yields are much more in line with government bonds, and it's much closer to cash. So on the left here, we've got the yield on each of the counters. And you can see it starts here at around 12% for some of the smaller illiquid companies. And then your foreign listed companies here at the bottom giving you around a 6% yield, as that's often in a foreign currency. That said, at a 10% yield, that's still an attractive return, and it's backed up by a discount to NAV. So, on the right-hand side, you've got your discount to NAV, which has been tested extensively in the market. So we still like that. We still slightly overweight our local property in a selected number of counters, but largely neutral. It's run out, and we're happy to take risk off the table. So then to summarize, that's the current breakdown of the portfolio. We've got 75% of the portfolio split between fixed rate and floating rate instruments, and so that's obviously from a risk management perspective. A lot of that is in government. We are very cautious of credit. I haven't gone down the credit route, which I did in September. But a lot of that is in government exposure. We're very comfortable that with the government bonds, and very worried about the corporate spreads. Duration overall in the portfolio coming in at about 2.2, but that's split across nominals, linkers, and foreign bonds. And then importantly, on the currency side, you can see how we've split the exposure into euros and pounds, specifically because we're so worried about the US dollar being overvalued. So a year ago, our foreign exposure was all in dollars, and we've actually gone into some of the other currencies here. The balance of the portfolio, as you can see, some small allocations to property at 3%, and then a little bit of pref shares remaining. I think we're one of the few funds that can still hold pref shares. We're small enough to go for that opportunity. There's 2 or 3 left it's an asset class that won't be with us for much longer. But while we can pick up a decent return there, we're quite happy to hold on to it. So in summary, the fund has done very well versus peers since inception. I think critically, the one thing we've been able to hold on very, very carefully is the risk. So you can see on a volatility basis, just over 2% per annum, lower than most peers, and a return that is higher than that. We focus on diversification in this fund. We want to give you as smooth ride as possible and not surprise anyone. Thank you.
Thank you very much for that. And Simon, I actually want to go on with you on inflation-linked bonds, because I'm really battling to get my head around inflation-linked bonds. Valuations a year ago looked extremely attractive, and if you invested in inflation-linked bonds, you got burned because you massively underperformed. How does the valuations in SA inflation-linked bonds actually work, and when do you really decide to buy them? We've seen that SA multi-asset low equity funds buy inflation linkers as a hedge, and the hedge worked, but there wasn't really great returns from it. Why is it different now at this point in time?
So both fixed and nominal bonds, fixed rate, both nominal bond and inflation-linked bonds have got a country risk premium. That's a component of the return, and it's got a that's common between them, but then where they separate is how they behave to inflation. So nominal bonds, you benefit from lower inflation, whereas inflation linkers, that's a detriment to return. They got burned because the worst case assumption a year ago was that we would bottom out at 4% inflation. But SARB's been running very, very aggressive monetary policy and actually dropped our inflation rate all the way down to 3%. What we've changed now in the past years, we've seen the interest rate cuts coming through. We've got a very clear path on where that interest rate cuts are coming. And it's also very clear where the risks are happening. Just like 2 years ago, when all the risk was in the nominal bonds and people were scared of them, it was the right time to go into them, to go and pick up that risk premium. You now sit with, in a strange way, and it's always counterintuitive because it's the other side of the coin. You sit with inflation linkers that are being priced as if inflation will continue to trend lower, possibly deflationary. And at some point you have to say, okay, but realistically, how long can that be sustained? At some point, the SARB has to cut rates further, if inflation stops falling. So you're starting to get a natural floor, and that's the protection investors have.
Interesting indeed. Nolan, maybe just quickly to unpack your note structuring a little bit better, and just for my understanding, does it mean the way you structure your bonds inside a note that you are less sensitive to duration when you structure it like that?
Yes. Sorry, I'm listening if the mic's on. It's on.
Yes.
So if you think back, and I was sitting here thinking about it, you think about that breakdown of the risks in a bond that I had. You had the sort of red bar, I think it was at the bottom, the US 10-year. Then you had the credit premium for South Africa, and then you had a sort of short-term interest rate differential between us and the US. What we're able to do is those are all tradable. I can trade US bonds, I can trade credit premium, etc. So we're able to isolate the components of that create the volatility, that create the duration, and say to the bank, keep that duration, sell us the other components. And that gives us an ability to manage the duration down. So you end up with significantly lower duration. Generally, market practices, we pretty much hedge out all of the duration. So you end up with a floating rate bond with a significantly superior potential return profile.
Thanks, Nolan. Melanie, just quickly on credit. You did speak to credit as well. A lot of people spoke on credit the past couple of 3 months, especially last year. We've seen a couple of blowouts. If you look at credit spreads at the moment, Simon also mentioned it, that the spreads are very low. There was something in the paper yesterday about Enable Capital, I think but that's a scheme, a fraudulent scheme, I think, that went belly up. Your views on SA credit at the moment, is it something you just avoid? Never mind the credit risk, just in terms of the spreads?
Yes, well, It's tricky to avoid all credit. As someone was saying, we've got a small universe, right? So you've got to take some banking credit. If you're taking NCDs, whether it's fixed or floating, you're taking on some credit. If you take government risk, you're taking on credit risk. It's government credit risk. So I don't want to label credit as being undesirable. But you're not getting rewarded. We want to be rewarded. You know, you sit in a year like this, you want the risk premium to be attractive for the risk that you're taking on. And every single auction we have, with a corporate coming to the market, spreads are just getting narrower and narrower. Now, we don't, because we're not running very small funds or small universes, multi-asset income's got quite a wide universe. I mean, we can do property, we can do structures, we can do all sorts of things. We can just do very vanilla floating rate notes issued by the government. Those are even a lot more attractive than most of the corporates that we are looking at. And you can look across for little pockets of opportunities, especially if you're a boutique. So I don't want to label credit as being terrifying, but there is one thing I know. The first one is that you don't want to chase credit when you don't think that the spreads are commensurate for the risk at any cost. So if the spread's too low, invest somewhere else. Secondly, right-size them properly. So, you know, I'm sure it gets spoken a lot that there are potholes or landmines when it comes to credit in South Africa because we don't have as freely traded a market as you do offshore. If there is something that starts to deteriorate its credit fundamentals, you can't just exit it. You know, you're stuck with it. No one else is going to buy it off you in this type of market. So right-size it. Don't have 8% of your portfolio in a name. It might be a fantastic yield, but you know that there could be risks associated with it. So diversify even within that credit bucket. And the third one I would do is say, I know that there's a lot of ideas of going offshore in credit, and I'm not saying there's anything wrong with that strategy whatsoever, but we know that in years of volatility that you get better entry points. So I don't feel confident standing in front of a bus. I'd rather wait for spreads to move out. You get that risk premium, which we're looking for, and then you embrace the ideas. So it just means being tactical, being careful, but most importantly, I think when it comes to credit, right-sizing each position size is your best defense.
For that risk management, of course. Our news panel, very, very briefly for comments on the budget last week. We get a lot of, or we had a lot of questions from clients. You know, is it glass half full, half empty? Nolan, if you can maybe comment on that. When the news broke, I mean, we heard some really stupid comments from some politicians out there, which I think was absolutely senseless.
Stupid politicians?
Imagine.
What are you talking about?
Is that recorded?
Why would those two things go hand in hand?
So interesting story. When the news broke, I was speaking at a BCI conference, as one does. And I was in Port Elizabeth, which
Yes.
you know, is actually quite close to the airport. So I'd finished on the panel, and we'd all hopped in our separate cars driving to the airport, and I think we'd all opened our phones at the same time, and we'd all seen the same headlines. And you kind of had myself and two other fixed income people hop off at the airport, and we were all like, "Did anybody see this coming?" And everybody goes, "No." So the honest truth is nobody saw it coming, okay, because I know I was sitting with a bunch of peers, and we were all like, what happened? Then we all start phoning, WhatsApping. Our economist is actually sitting back there. She was getting sort of fiery messages like, where did this come from? So complete pandemonium. How do we feel about it? The bad news is that the government has been woefully inadequate at reining in expenditure. Okay, expenditure has overshot what it should have, and as a consequence, they needed to find more money. Now, the problem is the money's already spent, so they're going to have to find it somehow, I guess. The other point I'd make is there was a bit of a lurch towards populism, so, you know, we're going to have a VAT hike, but we're going to sell it by giving above inflation increases on grants and all the other non-growth things. So that also was of concern. So those are the concerns. But the good news is government is working. The government and National Unity looked down at this and went, nope, it doesn't work. And in fact, they've gone back with a second iteration, and I saw a headline, which I haven't read yet, which said, nope, second iteration also doesn't work. So what are my takeaways? My takeaways are we've got a government that's actually having robust debate for the first time. 4 years ago, this was rubber stamped through. We've got actual people sitting asking the difficult questions. And they all came out of there locked in arms and said, yeah, we as a government agree we need to do better than this. So from that perspective, I actually take the positive away as well. What did the market think? Didn't really care. The rand moved by like 0.1%. bonds moved by like 4 basis points today. They're stronger than they were. So, I think it's all a wait-and-see attitude.
It's exactly that. And I mean, Simon, our currency didn't move. Is that just the market saying exactly that? All the bad news are in, or we just don't care?
Your guess is as good as mine. It was actually quite bizarre. It's like the currency would react, and it would just come all the way back. And on Monday morning, on stage 6 load shedding, we were actually convinced we would see the currency 20 or 30 cents weaker on Monday morning. Again, didn't happen. And I think there's either confidence in the GNU that things will get resolved, or it relates back to just a dollar that's really overvalued, and the rand has gone as low as I think Nolan also made this comment this morning. The rand has effectively gone as low as it can. That's my 2 cents on it.
We're going to mark that on the recording as well. It's gone as low as it can go. Right.
Brave man.
Melanie.
I just wanted to add to that is that I feel that, we've seen so many of these events before, right? And we always give ourselves so much credit. It's all about South Africa. It's only South Africa is going to drive our market. There's a global backdrop every single time. I think if we'd had those 2 events happen in a risk-off global environment, we would have seen a much higher heartbeat move. We had German elections with good results, which meant that anti-dollar, pro-euro, and pro-other currencies, that's maybe why we were insulated a little bit in the currency front. And we've seen a bit of a rally in US treasuries, and hasn't been a risk-off environment that's insulated us. So let's not catch that on a day that is a big global risk-off day. Then I think we'd see a much bigger reaction.
Very valid comment. I'm going to finish this panel on that note. Thank you so much for coming through. Simon, Nolan, Melanie, always great to have you with us.
Thank you so much.
And we'll see you soon. Thank you.
Lovely. Thank you.
Right, our last panel, or the last session for the day on multi-asset. And I always say this is where the things come together. You've heard good arguments on bonds. You've heard good arguments on fixed income. Last week and the week before that on the global webinars, good arguments on global equity. But where do we stand in multi-asset funds, and how do they put it together? For our next speakers, first up, we've got Chantal Baptiste from Fairtree. Then we've got Rory Spanenberg from Vanani Asset Managers, Paul Bosman from Granite, and Mark Seymour from North Star Asset Management. Chantal, if you're ready, we're going to see if we're going to have any predictions this time around, but we're going to cut that short. Maybe while Chantal is coming to the fore, Chantal is going to focus on the equity carve-out of the multi-asset funds they manage on behalf of BCI. So they do manage to select equity, pure equity. They've also managed to select balance. And then the Fairtree select BCI cautious fund, but mainly focusing on the equity carve-out as the main driver of returns. Chantal, thank you so much.
Goedemiddag allemaal. Thank you so much to Robert and Tanya, Eugene, Olga, the whole team. It's always a pleasure to be part of this amazing platform. I'm going to be chatting a little bit about the Fairtree BCI Cautious Fund. I'm an equity portfolio manager, so I'm going to be focusing more on the equity carve-out, but I just wanted to remind you what this fund is about. You can see it's incredibly defensive. The lion's share of it is sitting predominantly in SA Cash Plus, bonds, and credits. So the point or the purpose of the fund is to try to provide investors with a very stable, consistent type of return. Where we have the fun in the fund is that top grey part, the 35% SA equity. And that's the part I'm going to be chatting about a little bit now. It's not going to be boring, don't panic. I'm just going to be talking about what we're thinking. So I think it's important to maybe step back and just set the tone of where we are in the world right now. We have got Trump 2.0, tariff man, whatever you want to refer to him as, for the next 4 years, and a little boy from Pretoria in the background running the USA at the moment. So it's going to be a very, very interesting time. There's a lot of known unknowns, and I think Trump is going to provide us with more and more of that. What I keep saying to clients is, when Trump opens his mouth, step back and try and understand, is this his target? When he announces a policy, when he announces a tariff, when he announces a tax cut, when he wants to deport a certain part of the population out of America, is this his target? Is this what he wants to achieve? Or is this his tool, his slapping tool? Is he trying to get something else out of this? And I think you're going to see a lot of that. Then, if we segue into China, we had the beginning of the year, which was really interesting. You had the DoD announce on the 7th of January that Tencent would be placed on the Chinese military risk list, which caused huge detraction, and that process in Naspers pulled back. And then just before China went on their Lunar New Year, where they shut down completely and they go on holiday for a period of time, literally the day before, they dropped the mic and they released DeepSeek. Why is that important? Because they basically did it with a calculator and bubblegum. That's how cheap it was, in contrast to what all the AI companies, especially in the Western part of the world, are saying. So the Western part of the world is aiming to spend over $200 billion over the next few years, actually spent that amount in 2024. And justification is this is very expensive. It's very delicate, it's very technical. We've got NVIDIA chips and they're very expensive. And China kind of came out and blew them out the water. So this is going to be a very interesting space to watch. China is trying to reboot. It hasn't been growing for some time. It's been very disappointing. You saw Xi Jinping meet with all the tech companies about a week ago, and we saw Process and Naspers rally off the back of Tencent recovering a little bit. We don't know when China is going to recover. They are still growing at 4 to 5%, which is decent growth on an incredibly big base. But there is a confidence crisis in the system. The property market still hasn't bottomed. So this year could be the year, but I kind of said that for the last 2 years, so I'm not 100% sure. I went to China last October, spent about 2.5 weeks there. It was an AI, EV, electric vehicle, semi-chip conductor tour. So met a lot of companies, went to about 5 different provinces. Super, super interesting. If you catch me at any conference anyway, let me talk about it because there were a lot of takeaways. I just don't have time to go through all of it now. But what I walked away from is China is definitely investable. There's nothing broken in China at the moment. It's an investable country. And then lastly, South Africa. I think the previous panel mentioned quite a few things. We started this year, and I think it would be naive to think that the GNU would just ride off into the sunset and be the most amazing thing. There's obviously going to be friction. You've got the incumbents that are used to doing what they want to. That's why we had the budget that never was. Didn't happen because we've got the incumbents saying, this is what we always do. And suddenly you've got the DA coming through and saying, you can't do that. You've got to consult with us. We also had the expropriation bill that was announced, and that garnered very unnecessary attraction from the US. And again, do you really think that Donald Trump gives a sausage about the white Afrikaans farmers in South Africa? No offense, I know there's a lot of you and relations in this room, so I'm not trying to offend you. I'm just trying to say, do you really think in the grand scheme of things he really cares? No, he doesn't. So again, is this his target? Does he want to export all of you and your friends and your family to America so you can start millie farms? No, he doesn't. It's got to be something else. What does he want from South Africa? And that's what you've got to keep asking yourself. But we are very constructive on South Africa. We've tilted a big part of the portfolio into SA Inc. because we're actually starting to see the green shoots of recovery. Slow, very slow. We're seeing the impediments to growth starting to diminish. I know it's hard because we're in load shedding at the moment, but we think load shedding is going to get less and less. We think we have less of a power issue, but constructive on South Africa nonetheless. If we look back on last year, I know we're already deep into February 2025, but it's just important to see what worked. Mag 7, still top of the pops, has been for a few years. And then you can see in the middle there, it was quite nice to see some South African sectors and counters do well. Food producers in South Africa did very well. Property did very well in South Africa. Retailers did incredibly well. Right at the bottom there, though, China was very unloved. If you look at the asset classes on the right-hand side, gold continued to do very well. We had very nice attribution from our gold exposure in the portfolio, as well as copper. And then right at the bottom there, the very unloved iron ore. Remember, iron ore goes into steel production, so anything that's infrastructure intensive, and the biggest consumer of that is China. They're not firing on all cylinders. So iron ore continued to track sideways, as well as the PGM, palladium specifically. We look at this year to date, it's a bit of a reversal of what we saw. You can see now at the top there, SA Resources actually performing very well. And a big chunk of that is iron ore. So that actually started to recover a little bit this year. And then right at the bottom, retailers have given back a huge amount of performance going into this year, as well as the Mag 7. Because of that AI announcement, there was a bit of pressure on those stocks. From an asset class perspective, palladium, who would have guessed palladium top of the pops at the moment? We saw that little recovery at the end of last year, but palladium doing well. What does palladium go into? Vehicle manufacturing, predominantly. So a little bit of a reversal, but nonetheless, lots of opportunities to play with. If we look now into the world, quickly pausing on the US, China, then South Africa, I'm not a bond person, okay? I'm not smart enough to be a bond person. The previous panel was that. But what they sometimes don't explain to you is why these graphs are important, okay? So this is very, very simple. The black line is what Jerome Powell thinks. Jerome Powell is like our Letsetsa, the head of the SARB. Jerome Powell's the head of the Fed, the central bank in the US. So the black line is telling you what he is thinking at the moment. The orange line is telling you what very smart bond investors. So the bond market is a great proxy for what the market's feeling and what they're thinking. When you see interest rates cutting and coming down, it very, very rarely coincides with bond yields going up. This is unprecedented, okay? This is very, very unusual. You don't get times like this. It's very, very weird. So what the bond market is telling you, the orange one, which has gone up about 100 basis points, is that if they look out into the future, like one of the previous panelists said, if you look out into the next 12 months, they see a bit of risk, they see higher inflation, and they want more insurance policy for taking a bond. Okay, that's what they're looking out. They're saying, we can see growth, but we see a bit of risk, we see high inflation, we want a little bit more for investing. The black line there is the central bank in the US, which you would think is incredibly smart and knows what they're doing. They're looking out and they're saying, inflation's definitely come down, it's going to continue to come down, so we have room now to cut. Another reason they could be cutting is because they see a recession on the horizon. You wouldn't cut if you think things are going to continue to rock and roll like they are. You wouldn't cut if you think employment's going to get even fuller than what it is. So this is very perplexing, and this is where we are in the world. When you look at what central banks are thinking from a policy perspective, and you look at what the bond market is expecting, it's in opposite directions. So either that black line needs to go up again, or that orange line needs to come back down. I don't know which direction it's going to go in, but it can't continue to do that forever. So we're operating in a very unusual environment where the world's trying to understand what's going on. Because of this policy uncertainty, I think this happened last time. Are the slides moving? No. Thank you. Because of this policy uncertainty, and you can see that's the orange line there, it's peaked again. The last time we had that type of peak is 2020, just before COVID. So this is looking at the globe. China's a big part of this, US is a big part of this, and it's the market saying, I don't understand what the policy is here. I don't know what the monetary policy is. I don't know what China's doing. I don't know what Jerome Powell's doing. I don't understand it. And gold is a very good sentiment metal. So gold does well in an environment where we don't know what's happening in the future, when we expect a lot of uncertainty, when you think inflation might be structurally higher. And importantly, it's also done well because it has structural supports. This is the amount of central bank gold buying. I'm not talking about the equities. They're not buying gold-filled stocks. They're buying bullions. Okay, they're buying physical gold. Who's buying it? The East is buying it. Russia, China, as well as India. Why is that? Because when we had the Russia-Ukraine invasion, Russia got cancelled from the global monetary system. They couldn't access their dollars. And China and India looked at this and said, shucks, they could do the same to us. Let's diversify away from dollar. I'm not calling for the end of the dollar. Let's just spread our love a little bit and let's buy some gold. That's been a key support for gold. Gold's not the only commodity that's looking interesting. Other commodities are too, but predominantly base metals, not bulk metals. So base metals, copper, zinc, iron, aluminium, stuff that goes into greenification, stuff that goes into electricity. I love this graph because obviously I did it myself, but more so because it tells you so much. You can see on the left-hand side, this is the amount of money in dollars that your global mining companies are spending. Is a mining company capital intensive? Yes, it's very capital intensive. I don't know if you saw Amplat's flooding this week. You've had a hell of a lot of rain up this side. There's a dam that burst. It floods. When stuff goes wrong in mining, it goes horribly wrong. If you talk to any of the mining CEOs, they'll say, when you pick up a phone, it's normally when you're on the golf course or it's a Sunday, and your foreman, your chief guy says, Meneer, jy gaan my nie glo nie. You know that whatever comes out of his mouth next, you're not going to believe it. It's when lightning strikes twice. It's when the mines flood. So I'm stressing the point, these are very capital intensive. But look what they've done. So this is the amount of capex that they've been spending across the biggest global mining companies. Up until 2015, commodities rolled over. Anglo PLC, Anglo America, almost went bankrupt in that December. They almost did a big rights issue, and then they recovered. But look how conservative they've been. They haven't been investing in their own operations. They haven't been doing any exploration. They haven't been extending their mine. They've just been doing stay in business. On the right-hand side, that's what the big tech companies have been spending. So the mining companies have been spending on average about $40 billion per year. Tech companies last year spent $200 billion in capex. Okay, they're tech companies which aren't meant to be capital intensive, but they're spending on electricity, data centers and the likes. That's very, very good for your likes of copper, but maybe this does reverse because of the deep seek, because suddenly shareholders are going to say to the US companies, why are you spending so much money? China can do it at 6 million rand. You're doing it at 200 billion rand. Please explain to me why. Segueing more into China now, this is the difference. The orange line is your tech-heavy, the NASDAQ 100. So US tech versus the black line, which is China tech. I've shown you this slide over and over and over again. And the jaws don't close. The bifurcation is nuts. And if you look at this graph, you have to say to yourself, okay, the black line is in China, the orange line is in the US. They're basically doing the same thing. They're both making a lot of money. But the one keeps going up and the one keeps going sideways. China's got to be uninvestable. Or this has to be the buying opportunity of a lifetime. And we filled our boots on Naspers and Process. It's done very well for us the last couple of weeks, but the end of last year, it was a detractor from performance. People like to hate China, okay? We grew up in a Western world where we like goodies and baddies and heroes and villains. In our head, the US will always be a hero and China will always be a villain. It's the way that we play it out in our mind. So it's easy to hate China, but you can't mistake that with the fact that there are pockets where you can definitely invest there. And I think China could do well, and we'll see the tension at the moment. It looks like Trump's going to go visit Xi, and we'll see what they decide on. Off the back of China, just one thing to comment on is the quantum of vehicles that they're producing, and this is nuts, okay? This is in total. Look at that. Sorry, I know that it's a little bit hard to see. I lifted it from another presentation, but that's, I don't know what you call that, turquoise line, okay, going up there. They exported 5.2 million passenger vehicles last year. Look how they've overtaken, they've pipped Japan, they've pipped Germany, they've pipped South Korea. It's not all electric vehicles. This is total exports of vehicles. A lot of it is coming here. I mean, if you drive through Pretoria, have you seen all the Havals and God knows what other names? A few Indian manufacturers, but if you drive one of them, they're actually quite lacquer. You must try it. Go drive it. We still have that Western mentality where you must drive a German sedan. They're really good, and you know what? They're very, very cheap. They are a fraction of the cost of the European vehicles. China's flooding the market with vehicles. If you talk to Standard Bank, last year in their VAF business, 40% of vehicle loans were to Chinese cars, not to European cars. So it's just interesting how they've overtaken the world. When I was in China, this NIO is a company. It's the biggest, or one of the bigger EV producers, electric vehicle producers. And that's just their market share if you look at pure electric vehicles in China. I'm not talking about the world now. They have a 68% market share in China. They've completely outgrown Audi, Benz, BMW. And what's cool about this specifically is it's solved for the battery anxiety. So what you do is there's 2,800 little stations all across the country, and you buy your car, but you don't buy the battery. You lease the battery, and you buy a subscription. So every month you can have 80 battery changes, for argument's sake. You drive in, like a little station. There's no humans. It's all recognized through your vehicle registration. The robots lift your car, they change your battery, and you drive out. 3.5 minutes, quicker than filling up with fuel. That's their technology. They've captured the market. You cannot think that anyone else in the world is going to actually catch up to them. And that's the price of their car. We drove their cars. Beautiful. You go from 0 to 100 in 2.7 seconds. Not a sound. Stunning. There's a little place at the bottom for your handbag. You can have it in pink if you want. 750,000 ZAR equivalent. You cannot compete with China when it comes to vehicles. And then lastly, Eugene, I know you're panicking. It's basically my last slide. But just maybe coming into South Africa, what I think is important is that We have become accustomed to living in a country, that doesn't grow. We've got used to it. Gotten used to it. We can't remember. Human memory is very, very short term. Look how we grew for the period from 2000, the 5 years leading up to 2008. Yes, I know coincided with the Chinese supercycle. I appreciate that. I'm not calling for another Chinese supercycle anytime soon. But we are a commodity exporting emerging market country. We are meant to grow 3 to 4% on average. That's what we're meant to do. We haven't been doing that. But look what our counters could do. So look at the earnings generation of the banks, the industrials, insurance companies. The retailers, the industrial companies. High double-digit type of growth. Our banks returned 27% per annum over that period of time in earnings. That's very powerful. It means they're making a lot of cash, they can pay down debt, they can buy new businesses, they can give it back to me and you as a shareholder in the form of ordinary dividends, special dividends. Fast forward your eyes to the last 6 years building up to the end, December 2024, end of last year. We grew at 50 basis points per year. In real terms, we actually stood still. We've gotten used to it. I mean, I take my hat off to the corporates that can still actually grow their earnings at that level. 7% is actually very, very good in a country that's not growing. There's no GDP growth. What happens if we go back to 1.5% GDP growth, 2% GDP growth? You'll get quite excited. Sounds like a lot. It's a lot off that base. But we don't think that far. We think, okay, we'll just carry on muddling on. What if we get it right? What if power is secure in the country? What if we get Transnet right? What if there's actually accountability from a government perspective? What happens if the rating agency started to notice? I mean, look, S&P last year, they revised us back to a positive outlook. What happens in the next 5 years if we do incrementally a little bit better, not a little bit worse? What does it look like? It looks very, very attractive. Remember, South Africa, if you had to think of it and compare it to property, it's a well-built house in a fantastic location, but no one's put a cent in it for the last 20 years. So there's no windows left, the roof is blown off, the front door doesn't work, the plumbing needs a bit of maintenance, the electricity is okay, but you probably need to invest, you need capital in it. That's what South Africa is. It's not a cuck house in a cuck location. It's a strong house, okay? We just need to fix it. So we're actually very constructive from a South African perspective. And then this is the way we've tilted the portfolio. So you can see, I drew that line through there because for a period of time, Fairtree got deemed the resi guys and token girl. But we do invest in other parts of the JSE. That was just the place we wanted to put our clients' money to create alpha, to create performance. We've reduced resi considerably. At the moment, it's about 28% of the portfolio. At one point in time, it was probably sitting at about 62% of the portfolio. We've lent into SA Inc. quite considerably, but it would be amiss of me not to say we're obviously an externalized market. If Trump really decides to target us, it will be a headwind towards us. If we're operating in an environment with a very strong dollar, and if US yields keep going up, it's not good for any emerging market country. So there are global headwinds, but structurally, I think we are starting to improve. So rotated a lot into SA Inc., still have consumer rand hedges, which is by and large our exposure to Tencent through Naspers and Process. Bit of defense at the top there because we are in this crazy environment. And gold is one that it looks like I've kept it the same all the way through, or at least since, say, 2020. We've been very, very active. This is going to be a very, very volatile year, okay? It's going to be a year that your clients are going to say, please just give me absolute return. Please just give me 5%. I don't care about crazy return. I just want 5% so that I can sleep well at night. They're going to look at the equity markets and they're going to keep phoning you and say, go out of equity. Tell them to stay invested, okay? Back the smart asset managers, because perversely, in these type of environments, your smart active asset managers in the equity space can actually eke out a lot of performance. Thank you so much for your time. I appreciate it.
Good afternoon, and thank you very much for your attendance. Eugene, I'm not sure whether you introduced the panel members at the start. I popped out to the loo. But Rory Spangenberg, Head of Global Equity at Vunani Fund Managers. I'm going to talk today about our flexible approach to global equity within a multi-asset context and what the benefit may be to you and certainly to your clients. We've heard quite a lot today about volatility and uncertainty, and I think that plays right into where we sit in an environment where we manage a flexible fund, the ability to diversify across multiple asset classes, and specifically also choose not to be invested when we think the risk reward is just not on offer. And that translates, I think, into benefits for investors ultimately, and certainly for yourself as advisors, less work probably, by utilizing a flexible mandate that has the ability to alter risk tolerance or asset allocation on your behalf, less frictional costs for your investors. And then most importantly, I think having the decision in the hands of a dispassionate professional, making those calls on your behalf, and ultimately also through an enhancement in risk-adjusted returns, keeping your clients invested. We all know that the biggest damage investors do to themselves is buying high and selling low. And there are a lot of academic studies that support that, and from your own experience, you'll probably concur. So Vunani has managed a global flexible equity strategy for close on 12 years now. And over that time managed to match the equity market return, but with significantly less volatility, drawdown risk, and therefore a significantly better Sharpe ratio than the equity market overall. So delivering equity-like returns with downside protection. We don't manage the fund towards the MSCI World Index. The fund has a composite benchmark of which the MSCI makes up 80%, the balance being in US T-bills, and because it's a rand-denominated fund, 5% allocation to the STEFI composite. But here you see, I think very clearly the benefit of active management. And that, again, I think has been the theme of the day. In an uncertain, volatile environment, the ability to move quickly and to manage the portfolio in an active way and embrace opportunities as they present themselves. We tend to look at returns in a very arbitrary, particularly when it goes against you, periods, windows. My preference is to look at rolling returns. So what I've done here is I've showed the 12-month rolling alpha, the returns are all in dollars, by the way, of the fund or the Gibbs composite, of which the Vunani Global Macro Fund is part, relative to the MSCI World. And what is evident there is that the fund tends to underperform in strong markets and tends to make that up in weaker markets. Specifically, if you look at the drawdown October to 2020 to October 2021, the MSCI had delivered an annualized return of 41%. The fund underperformed, but at the same time, still delivered a very compelling absolute return, which is ultimately what we are striving for. So I think what you see there quite clearly is upside participation, but significantly less downside participation, which is what investors ultimately respond to. So you see it here, this is not the greatest graph, but I've highlighted there sort of some of the key points when we talk about drawdowns and the difference between 25 and 23 in just sort of around June 2022. Recall that in the market bottomed in September 2022. In fact, on the very last day of the quarter. And from January to that point, had lost close on, is that 25%. 2022 was the worst year collectively for equities and bonds in 150 years, according to data from Morgan Stanley. So there was really no place to hide. And that speaks directly to diversification, and that's something I'll come back to later on, how and when to diversify, but as you see there, it doesn't always make sense. So the return profile of the fund over 5 years, more recent history, you can see we've lagged the MSCI World. Market returns have been very concentrated. I think we all know that story, but with significantly less volatility. Since inception, matching the equity market return in dollars, a little over 10% per annum, but with meaningfully less volatility. I think the concept of volatility and risk is probably a whole another presentation. But I think why we use it and why I think it's important is that's generally what investors respond to. And what you don't want is your clients responding to that volatility at the time when it's darkest before dawn. So we think this risk-adjusted return profile of the strategy meets that demand. So that's the performance history and the sort of risk profile of the fund. Let's talk a little bit about where we are and what opportunities might exist. I'm showing here, since we're talking about multi-asset, one has to always have the alternative in mind. So this goes back to, is it 2012, 2013. The risk-free rate was literally set at zero for a long period of time. Recall the response to the global financial crisis was financial repression. That meant monetary policy authorities were trying to push investors to take risk, so they set the price of money very low, and there was really no alternative. Risk-free meant return-free. That has changed. 1-month T-bills are offering a yield of a little over 4%. There's little to no term premium to speak of, but for once there is an alternative. But return is one thing, and building multi-asset portfolios is really about the correlation of those returns and how you construct a portfolio of uncorrelated return opportunities and how they relate to one another. So what you see here is that over short periods of time, certainly over the 12-month period, which is the light blue line, that rolling one-year correlations are clearly not stable and probably not that reliable, and certainly very volatile. Over longer periods of time, bonds relative to equities, in this case, S&P 500 and US Treasuries, bonds have been consistently negatively correlated to equities. In other words, you were being paid to diversify. And what we've seen over the last while, 3 years or so, is that correlations have been rising and are now positive. So is the diversification opportunity really there when correlations are positive and as positive as they are at this point? I think we need to pause and reflect on that. But one needs to ask why that is the case. And I think Melanie in particular illustrated the policy uncertainty environment very, very well in her presentation earlier. The macroeconomic backdrop is uncertain. Interest rate volatility has spiked. Investors are uncertain about what the economic agenda may be. We've heard a lot about tariffs, etc., and it's being reflected here. The other point I would say is that even though we were just at the point where we're thinking that the inflation spike that we lived with had been addressed, that along comes tariff policy from the US president that undermines that, and the Fed has gone from being relatively dovish at Jackson Hole in August to taking a wait-and-see attitude. So with all that noise, uncertainty, how do we approach the exercise of making the decision on whether to increase or decrease the risk tolerance in the fund and how to diversify? And the answer to that is that we are resolutely bottom-up focused. We would like to fill our portfolio with the best equity opportunities we can find, should opportunities arise in other asset classes, we would make use of them, but we're also very happy to sit on the sidelines. So what I illustrate here is our proprietary bottom-up valuation indicator. We have 100 stocks on our global buy list. Each of those has a proprietary bull, bear, and base case, which are scenario weighted. And that gives us an idea of what the bottom-up expected return might be. And you can see that is offered at a little over 15%. Maybe 16%, is the sort of the middle average line over time. What I've overlaid on top of that is the subsequent 52-week return from the equity market. And it's not a very strong correlation, but it's a positive correlation. And we use this as an indication of how much risk to assume in the fund. Right now, we actually have a neutral stance on equities. In other words, we're 80% invested. But what's very clear from our own proprietary data is that if you bought the optimal portfolio, which is not constrained in any way, your portfolio would be skewed meaningfully away from the US and significantly exposed to typically defensive sectors such as consumer staples, healthcare, and the like. And in the institutional context, or when you're managing other people's money, you have to have a sort of risk framework around that. And so we'd not buy the optimal portfolio, but certainly we are directionally aligned with the optimal portfolio. So we've been underweight the US, we've been underweight technology, we've been overweight healthcare, and we've been overweight consumer staples. And while the underlying equity portfolio of in the flexible strategy underperformed in the calendar year by give or take 5% gross of fees, a substantial portion of that was made up in January. When we saw the DeepMind news, I think it undermined the questions in market participants' minds about the strength of the competitive advantage or the moats inherent in some of these large global technology companies, particularly NVIDIA, which we think is just grossly over-earning at the moment. And as soon as supply catches up, their operating margins, which over time have averaged 20% and are currently at 65%, will sort of respond to financial gravity and revert probably towards the mean. And I think DeepMind or DeepSeek illustrated that risk. So capacity will catch up, the costs will reduce, you'll probably have an uptick in adoption rates, and that's actually the typical sort of technology cycle. So it's playing out, and we think that NVIDIA actually runs the risk of becoming the Cisco of the AI period. And so let me conclude in time. The BCI Global Macro Fund, which is a constituent of the Gibbs Composite I referred to, is approaching 4.5-year track record now. And over time, I think it's shown a very consistent performance track record. We just missed out on the top quartile in over 1 year, but 12 out of 44, that puts us, I think, in the 27th percentile. Quite happy with that outcome. And thank you very much.
So where are we in the beginning of 2025? The US is expensive, especially tech. AI is booming, but it's expensive. China is ex-growth. Capitec is great, but it's too expensive. Property has had a pop, but get out and stay out. And SA could be a fantastic investment if the GNU executes. All of these seems like reasonable consensus at the moment. Let's dig a bit deeper. This is corporate spend on R&D by country. As you can see, the US spends a huge amount of R&D on the corporate side. This we see as the fuel in the tank for growth. This is labor efficiency, so output in the US on a labor measure relative to the G7. It's amazing what's happened since the early 2000s. The US efficiency on a labor point of view just keeps improving. We believe what you've got here is you've got a full tank and you've got efficiency. And that is what you need to go far and to go fast. Mathematically, what we do is we say return on invested capital times the total capital invested gives you growth. The US is investing a huge amount of capital. They're generating a high return on that. There will be growth in the US. There will be a lot of growth in the US. Remember that people get rich not by buying low PE stocks. They get rich by buying companies that grow and keeping them for a long period of time, like Microsoft. Those companies are doing huge amounts of R&D. They're investing efficiently. and then they grow and they generate good returns. So it is true that there are expensive stocks in the US, but it's also true that if you want to go far and fast, you need to spend on it. The next thing is AI is booming, but it's expensive. Let's have a look at that. Data processed worldwide in 2010 was 2 zettabytes. 2024, 147 zettabytes. That's a 35% per annum compound growth rate in data processing. This trend will continue. The intensity of data processing will continue. We think you should invest in this vector. There's one trick, and that is you can't just invest in growth. You've got to invest in a company that has a sustainable competitive advantage on the growth vector. A growth vector attracts capital. Capital competes away your profit. You need to find a strong competitive advantage on the AI vector, and you'll make a lot of money. Maybe it's NVIDIA, maybe it's not. We're not sure. We don't invest in NVIDIA. We've got a few other names that we believe have got a sustainable competitive advantage in this space, and they're usually large positions in our funds. China's ex-growth. This chart indicates the number of companies that are in the top 2,500 R&D spenders from that country. So let's just focus for now on the red line. That is the number of Chinese companies that have joined the top 2,500 CapEx spenders in the world since 2013. It's a staggering displacement of the rest of the world. R&D today determines growth in the future. And let's think about the opposite of that. No R&D, no growth. So the growth of China will be picking up. This is the spend on research of the government as well as universities in the US and China. That red line is especially interesting. It's applied research and experimental development. Look at how quickly that is growing in China. Spend today results in growth in the future. We think China will be growing for a very long time to come. Capital is expensive, so avoid it. Rather buy the other banks, they're cheaper. Does anybody want to guess what those percentages are? So the red line is the PE ratio of Capitec since it listed in 2002. Every time you bought Capitec on its peak PE ratio, that is the compound annual total return you would have got up to today. So if you bought Capitec at its peak PE ratio, you got a 30%, 25%, 17%, even 14%. That PE ratio is a very strange number. It was COVID provisions. Total return per year if you bought it at the highest PE ratio it trades at. So if you bought it any lower, you obviously did far better. So buying a company that grows for a long period of time makes you money, not trying to time the PE ratio. Property had a pop, get out, stay out. This is the price to book ratio of a company we invested in, Unibel, Rodamco, Westfield, mostly in Europe, mostly operated in Europe. Let's look at this as a case study. So the net asset value is about 140 euros. The share price is about 70 euros. It's up a bit lately. They make about 10 euros of profits, and they'll pay out more or less half of that over time. So you get 5 euros of dividends. If we move from more or less a 50% discount to the NAV to 75% discount to NAV, and we add our dividends, we get a 57% total return. This has not happened yet. This can happen. At that point, you're still at a 75% discount to your bottom of the cycle net asset value. Your dividend payout ratio is still 50%. It will normally go up to 80%, 85%. And that dividend will grow. We think the property cycle has only just begun. It tends to be 20-year cycles. To say it's how to pop, get out now, we couldn't disagree more. We're only just starting to make money on our property investments, and some of that money is up 50, 60%, but we think it's just the start of a cycle. So the GNU, you'll make good money if they execute. Have a look at this. So this is Standard Bank's dividend yield. And if you invested in Standard Bank over the period that one of the previous speakers spoke about, 2003 to 2013, when our GDP grew very nicely in South Africa, you made 16% per year out of Standard Bank. GDP grew at 3.4% on average over that time. But look at the next 10 years. Our GDP hardly grew. It grew at 0.5%. You still made 11% out of Standard Bank every year. Importantly is that dividend yield, your starting point dividend yield where you are today is 6.5%. It's never been that high when you take one of these measurement periods. So if we grow at 0.5%, you're going to be fine. You're going to make inflation plus quite a lot. If we grow at 1%, 2%, 3%, you're going to make staggering returns from Standard Bank. So we think there's asymmetry in our good banks at the moment, that you'll do okay if we don't grow, you do very well if we do grow. So our portfolio is invested in the US because we think there will be good companies in the US, and they will, from a technological point of view, they're ahead and they'll stay ahead. They'll grow for a long period of time. AI, we think, is not going anywhere. It's actually just data intensity, which is a trend which will keep going. It'll grow fast. China, it's hard for us to find the kind of companies we really like in China. We've found two, but we keep looking. Capitec is a big position of ours. Property, we've got property in South Africa, UK, Europe. And in South Africa, we've got a number of stocks that we think will do fine if we don't grow our economy, and will do very well if we do grow our economy. Thank you very much. I'll hand over to Mark.
Okay, good afternoon, everyone. Thank you so much for this opportunity. Nice to see some familiar faces. Thanks, Eugene and the team. And yeah, thanks to the speakers as well. They finished on time, so I don't have any excuse if they don't finish up by 1:15. Today, I want to talk about North Star and how we do asset allocation. And specifically, I want to be able to just leave you with a strong sense of how we go about that process. So I'm not going to be doing a big product push. I'm not going to be talking about specific dynamics in the market. I'll just be summarizing that process. Okay, so this is a familiar face, Warren Buffett, one of the most famous investors, successful investors, and he's got an interesting quote: "Diversification is protection against ignorance." It makes very little sense for those who know what they're doing. That certainly does make a lot of sense. What's quite interesting, though, is that if we dig deeper into the investment process that Warren Buffett follows, there certainly is an element of diversification. So, yeah, it's certainly true. You need to apply your thinking and be able to get exposures to the right points in the market, the right asset classes, and in punch in a format to be able to generate outperformance. But certainly, if we look at his portfolio over time, he certainly has leaned into different asset classes. And so, broadly speaking, we can see here cash, bonds, preference shares, equities certainly have made up his portfolio over time. And then also, if we delve into his listed equity portfolio, we can see there as well a number of stocks that he's had exposure to over time in the region of between 50 and 60 odd stocks. That's quite typical of a sort of high impact kind of equity portfolio, but certainly lots of scope for diversification. Next up, this quote by Harry Markowitz: "The only free lunch in investing is diversification." I think this we quite like this concept, and it's a concept that's being communicated by a number of speakers today. Who is Harry Markowitz? He's less well known than Warren Buffett, but certainly quite an extraordinary man who, when he was 25 years old, initiated his ideas in terms of portfolio construction and diversification. At the age of 25, he wrote a paper. And many years later, he was awarded a Nobel Prize in economics for his work. So what is modern portfolio theory? This talks to the benefits of diversification. And this is quite a nice topic to cover. In this chart, if we start off with two different asset classes, the idea is that when you mix the asset classes, what's the impact? And now I know that intuitively, and a lot of us have covered the topic, but there's some kind of diversification benefit. This chart talks to that benefit. Okay, so, and what is potentially intuitive is that if you have bonds and you have equities and you start adding a little bit of equities to your bond portfolio, that your risk will rise proportionally. Shall I stop? Okay, we'll carry on. But that is actually not the case. What you find is that because of the correlations between asset classes, interestingly enough, when you mix them together, you get a better risk-adjusted return, which is represented by the red chart. And so, yes, higher return for lower risk. That's the crux of the story. So how does this work in practice? If we have a look at a bunch of different asset classes priced in rands, we have a look at cash and equity, local equity. What you can see is that there's not a big diversification benefit when you mix these two asset classes. It's almost like a straight line between the two in terms of return versus the risk. That picture starts to change when you look at other asset classes like local bonds, and you can see here, over this period, local bonds hasn't done that well. Over the shorter term, it's done much better, but even over this period, you can see that as you start adding equities, you have a much higher, you have a benefit of that risk-adjusted return, better risk-adjusted returns. If you look at global bonds, now we're into a different realm here. You start incorporating the movements of currencies and the drivers on global bond markets versus our market. And what's quite interesting there that, as you start adding some equities to your global bonds, interesting phenomenon is that you can have a rise in return and even at a lower risk. And likewise with gold, as quite a fantastic portfolio diversifier. So even though the returns on gold has been well below local equities over this period, you can see that even though both those asset classes are operating at around about 20% standard deviation, by adding the two together, you can actually get a return that operates at a standard deviation of 14. So it's just very interesting in terms of the benefits of diversification. And then global equities, you can see there as well, huge benefit of incorporating diversification, and certainly as a function of those different drivers. And then when you take it a step further and you start mixing all the different asset classes, you start generating a range of different returns. And then the crux of what we're trying to do, what I'm trying to point out today, is looking at the efficient frontier. Now, the efficient frontier is a bit of a game changer in terms of understanding portfolio construction. And this is where I want to tie it back to how we do it at North Star. By doing this exercise, we just looked at historic returns, but what we do is we focus on forward-looking returns. And by doing that and identifying where the efficient frontier is, it's quite nice. You can break that down into equal steps. And that gives you a very clear idea about how your portfolio should be constructed, as long as obviously your return expectations are accurate. Okay, so just having a look at, for the sake of way of example, looking at the medium high risk bucket of asset classes going back for that period, just to kind of illustrate the benefits of having a diversified portfolio. You can see that level of risk has given quite a smooth set of returns in the South African context versus inflation. So certainly looks pretty good on that front. But what's quite impressive is that white dotted line is the inflation plus figure that mix of asset classes has delivered. Tian, I can see you stressing here because that's on a before cost basis. Thank you very much. Okay. And then just having a look at those mix of asset classes, and it's quite intuitive. You can see that for a low risk portfolio, largely dominated by short dated fixed income assets with a little bit of exposure to a bunch of other growth type of assets. And then as you go up the risk spectrum all the way to the a sort of typical high equity balance fund exposure, you can see there that over that full history, for that level of risk, the optimal portfolio would have pointed you to a portfolio with a 66% exposure to equities, 44% local equities, 22% offshore equities, and then also the benefit of global bonds coming into the fore there, and some other asset classes. So certainly a nice framework for understanding portfolio construction. So at North Star, how we tackle this is all the work that we do goes into buy lists, okay? And each buy list essentially for one particular set of assets. So we've got a local equity buy list covering the local market, 80-odd stocks on that buy list. At any one point in time, 40-odd stocks in the portfolio based on the expected returns and a good blend across those stocks. The global equity buy list, same story. Screening the entire globe, over 1,500 stocks screened, distilled, researched into a shorter list of 100 stocks that are under model, and then from there, between 40 and 60 stocks that will end up in the buy list. And the same for local fixed income, same story, same dynamics, fixed bonds, inflation-linked bonds, floating rate notes, corporate bonds, looking for the best opportunities in that space. And then same for global fixed income, covering the globe, US treasuries, sovereign bonds, European corporates, US corporates, and trying to distill a return expectation out of that. And then lastly, overlaying potential currency dynamics. And we've mentioned some of those stresses currently, strong dollar. What does it mean if we have a weaker dollar? What does that mean for asset class returns? And then the same for commodities, etc. So we do that exercise, put it through a portfolio optimization exercise. We do this monthly, so we've got our buy lists, which we keep refreshed on a continual basis, and then we resort to doing a optimization exercise where we put those expected returns through this model. And what we have, or what comes out of that, is an idea of the expected returns versus the risks. And that's Monte Carlo simulation. So just throw a computational power at that, throw different weightings into those different buy lists. And then from there, as I mentioned, looking for that efficient frontier, and then essentially saying to yourself, well, okay, for each particular product, so at North Star, just to give you a quick summary, I mean, we've literally got 5 funds that we manage, 3 local funds, 2 offshore funds. But in terms of multi-asset funds, it's 4 funds, a local income fund, which is multi-asset, and our high equity balance fund. And then offshore, we've got a global income fund and the global flex. So this is particularly pertinent. We do all this work, we've got all these buy lists, everybody's got these wild ideas about all sorts of things about the world. That gets distilled into those buy lists. We then crunch the numbers, and then that very easily gives us a very strong guide in terms of we should position our portfolios. I mean, we would be nuts not to consider what comes out of the computer model. All the work goes into the buy lists. All the good work that's done by the analysts is honored by the process, and what comes out. So, for instance, the latest round of optimization for the North Star Managed Fund, looking at a 10% standard deviation. Another way of looking at that is looking at that efficient frontier and breaking it into 5 different buckets. You can see that it's sort of 4/5 of the way up the risk spectrum, which is a perfect positioning for the balance fund. And so as of the latest iteration, pointing to a return slightly below 16% and at that level of risk. And what pops out of there is a very clear sense of, based on our thinking, based on the buy lists, how the portfolio should be positioned. So it is quite interesting. There's quite a lot of agreement here. There's, we could see that out of this exercise, it's suggesting quite a large weighting to local equities. So certainly we're very positive on local assets. The global assets actually comes in at quite a low weighting, and that's also driven by what's coming out of our buy lists. Now, we fully appreciate that from one asset manager to the next, they're not going to have the same stocks, the same the numbers for the expected returns. At the moment, our global equity buy list pointing to roughly a 13% return in rand terms. And so, when you put it through this computational exercise, the allocation is downweighted somewhat. And then in terms of local fixed income, an even split between floating rate notes, fixed bonds, and inflation linkers, once again talking to the attractiveness in terms of that market. Inflation-linked bonds on very high real yields, inflation potentially bottoming at quite a low level now, and potentially with inflation ticking up, even though it's still well within the SARB's band, certainly lends itself to potentially very good returns. Outside of that, global bonds, I mean, if you rewind, pre-COVID, global bonds, no matter where you looked, it was pretty much a terrible asset class. There was just literally no opportunity. That has definitely flipped on its head. And even despite all the uncertainties and the risks that are out there, we're certainly in a much better position now in terms of being able to generate real returns out of global bonds. So certainly, that's the reason why there's a global bond component that comes through. Local property, okay, granted, our views in terms of what comes out of the model, favouring a better risk-adjusted returns from some of the other asset classes, and particularly in the equity space. Global cash, a small amount of global cash, with some local cash, obviously, and then a tiny sliver of gold. Now, that's actually been quite an interesting journey. Back in March 2021, when we started introducing quite a lot of gold, there were quite a lot of raised eyebrows. But certainly over the last year, we've been reducing that exposure. And gold has continued to rally really hard, and certainly for some of the reasons that have been mentioned by earlier speakers. But that's it in a nutshell. Just to reiterate, North Star, we like the idea of a free lunch through diversification. We like the idea of how we implement it in a very structured, easy, logical fashion. And it's something that we've been doing systematically for more than 10 years. And across our multi-asset products, they've all done extremely well. So I urge you to chat to some of my colleagues, Mike Clare, Alex Holmes, if there's any more information, or even come chat to me if you want to know more about what we do. Thanks very much.
Speaking of a free lunch, we're almost off to lunch, which will be in the restaurant when we break from here. So not in the foyer, just go around the corner in the restaurant. Big applause to all our fund managers here today. I think you've done a phenomenal job, especially the multi-asset session. If you listen to all of them very carefully, you don't get the big answer from one of them, but if you listen to all of them, you actually get a very good answer. Thank you all for that. To all of you here today, really great to see you. Pretoria is always a great venue to be at, and a fantastic audience, always being on time and interactive. Thank you. To the multimedia team, thank you for running things smoothly. The load shedding is not you, we know who that is, but all worked out well. Thank you so much from Amelia, Robert Walton, BCI team. Thank you. Robert still want to say something.
Thank you, everybody. The good news is this year we can move our global conference from Cape Town to Pretoria. We'll soon circulate details. It's going to be here, Tanya, the week of the 8th of May, if I'm not mistaken. So it's something new. I'm sure you're very happy for not being able to come to Cape Town anymore.
Are you going to organise for wine tasting as well in Pretoria, Robert? Right. Thank you all very much. It brings to close for a day. Please join us for lunch. Thank you.